Hello guys, I'd like to welcome you in the Flipping Markets video course. First of all, I want to introduce myself. My name is Marcel, aka Flipping Markets. I live in Hungary and I'm a session trader, which means I only trade New York Kill Zone. I created this video course to help you in supply and demand trading. I will keep this course as simple as possible because we all know that simplicity is key in the Forex game. There's no need to ever overcomplicate things, especially trading. That's why I kept my PDF and this video course simple. By the end of this course, you'll get a deeper knowledge about the supply and demand trading, and you have a great chance to become funded in a short period of time. So enough of talking, let's just begin. So welcome everyone in the first video. This unit will be about the supply and demand zones. As I said in the intro, I keep this course as simple as possible. First of all, what do we call a supply and demand zone? It's a zone where price rapidly pushes away from, so lots of orders were placed, creates inefficiency. Please pause the video now and check the inefficiency video before you continue to watch this, because it's necessary to check that video before you continue to watch this. So please just pause it and watch the inefficiency video. Okay, move on. It has to break structure or change character. We'll talk about change of characters in the entry unit. And finally, it has to create or collect liquidity. So we have three criteria for a supply and demand zone. And please grab a piece of paper and write it down, because it will be very, very important in the future to write these three criteria down, because you'll be able to identify the zones based on these three criteria. Okay, so the first criteria is, write it down, it has to create inefficiency. We call it IFC from now. Without inefficiency, the zone would be less valid, because zones with IFC attract price. So price has a greater chance to tap the zone with IFC than without IFC. Okay, the next criteria is it has to break structure or change character. A supply and demand zone will only be valid if it breaks structure or an opposite side zone. Let's see an example for this. Okay, let's see an example. As you can see, I just drew a higher high and higher low structure here, which is bullish. It creates a break of structures to the upside. Okay, as I said, price has to create inefficiency in order to create a valid demand zone or sub-high zone. Let's say this move created inefficiency. You won't see it here because you'll only see it in the live charts. But let's say this created inefficiency. As you can see, this broke structure to the upside. So it will be a valid demand zone. The third criteria will be it has to create or collect liquidity, but we'll talk about that later. Okay. We have the first demand zone right here. As you can see, price created another break of structure here on the upside. And let's say this also created an efficient move. Okay, we have the second demand zone right here. After that, price created a little structure, a little pullback, and reached its high. After the high, it changed character to the downside here. So after a change of character, price will automatically create a zone, either if it's a supply or demand zone. But we'll talk about change of characters in the entry units. Okay, so after a change of character, price created a supply zone because it will change of character to the downside. So this means supply is in control now. I will just draw a supply zone right here. And supply took over control because it broke the last demand zone, which was here. Okay, if price reacts on this zone, on this demand zone that created inefficiency and break of structure to the upside, price reacts on this zone and breaks through the opposite side zone. So this supply zone, that's why I meant by breaking through an opposite side zone, then it will become valid again. It will become a valid demand zone because let's say it created inefficiency with the movement and broke through an opposite side zone. So yeah, let's move on. Okay, so the third or the +1 criteria is the liquidity creator sweep. I said +1 because it's not necessary to create or sweep liquidity in order to form a valid zone, but it's a really, really strong confirmation. So the first and the second criteria has to happen in order to form a valid zone. So the break of structure and the IFC, it has to happen. But the third, so the liquidity sweep, is just a confirmation. Okay, we'll talk about liquidity sweeps deeper in the liquidity unit. Let's see the criteria on these examples. So the first one is a long example. As you can see, price, let's say, created an inefficient movement to the upside because you won't see inefficiency on this line. But let's say with candles, it created inefficiency. First criteria is fit. This was the last high point. This was the last low point. Price with an inefficient movement broke through the last high point, so it broke structure to the upside. So the second criteria is fit. Let's see the liquidity sweep will collect. We had liquidity trend line here. We'll talk about liquidity trend lines in the liquidity unit. So we have liquidity trend line here. Price swept the liquidity trend line, collected liquidity from above, and it created another liquidity on the way down. So it has double liquidity confirmation because it swept liquidity and created liquidity. So all of the three criteria are fit: inefficiency, break of structure, liquidity. Okay, the same goes on for the bearish structure. As you can see, price has a high point and a low point. Price did a pullback and created a break of structure to the downside. With impulse movement, let's say we have inefficiency here again. It broke structure because it broke through the last low point. It collected liquidity because we had a liquidity trend line here again. So price swept all of the liquidity from this trend line. Price created liquidity on the way back down to this zone. So it created liquidity and swept liquidity again. So all of the three criteria are fit. Let's apply these criteria on the live chart. So we are on the live charts right now on the 4-hour. As you can see, price was in a bullish trend. And after the bullish trend, price broke this trend and started to form series of lower lows and lower highs. So this means we are in a bearish trend right now. Okay, in a bearish trend, as we know, price will form supply chain. So supply zones over and over again being respected. This is a supply chain. Okay, let's find the supply zones. First, map out our structure. As you can see, we had the last high point right here and the last low point right here. Price broke structure to the downside with this movement, inefficient movement. So first criteria is fit because it broke structure to the downside here. Second is fit because it created inefficient movement. And the third criteria is fit because it swept liquidity. We have liquidity here. So price just swept that liquidity. And as you can see, price levitated back up to this supply because this will be our right supply zone. So price levitated back up to this supply and reacted on it. So I will just mark the structure. Price is currently moving in this range. We have a high and a low. As soon as price breaks this low point, it will create a break of structure. So one of the three criteria will be fit. Okay, let's see what will happen. It's moving in the range. Okay, it created inefficient movement, but it didn't break below this low. As you can see, this is inefficient movement. Okay, it broke below the low. So we have a new supply zone because it created inefficient movement, break of structure, and actually it didn't sweep any liquidity, but this is a really huge inefficiency. So this will be a valid zone. So let's just mark out the candle. We are waiting for this candle to be tapped or the last low to be broken. So this is our last low and this is our last high right now. As soon as this low breaks, we will create a break of structure and we will more likely to have another supply zone. Let's see what happens. Okay, as you can see, price created another inefficient movement to the downside and broke structure. So this means we have another supply zone, which is up here. Okay, let's play price. Waiting for a pullback. Okay, the pullback happened. So we are currently moving in this range. As soon as this low breaks, it will create a break of structure to the downside and will form a new supply zone. Wait. Okay, as you can see, price created another break of structure to the downside. So we have a new high. Sorry, we have a new high here and we are waiting for a new low. And this means we have a new supply zone also. I will use the wick, but I will explain later why did I use the wick in the wick explain video. Okay, let's just continue. As you can see, price created a new low, which is right here. We are waiting for a pullback. Price tapped the zone. Price reacted on that zone, created inefficient movement to the downside, but didn't break below the last low point. And it broke below because all of these breaks were just weak breaks. So I will count this as a real break structure because it broke below the zone with body closer. Okay, let's just mark out this zone. This will be our new supply zone. And this method gives on and on over and over again. You can mark out supply zones and demand zones based on these three criteria: inefficiency, break of structure or change of character, or opposite side zone break, and liquidity sweep or collect. Okay, let's see a demand zone example. Okay, as you can see, we are on the 4-hour chart again, and price is in a clear bullish trend because it's creating break of structures to the upside and forming series of higher highs and higher lows. So this is a clear bullish trend. Okay, before we continue this, I will ask you to watch the weak zones video because you'll need it to complete this task. And actually, I will give you your first task. I want you to mark all of the demand zones out on this structure. I will give you 1 minute for this task. Let's begin. So the 1 minute is over, and as you can see, I drew all of the zones that has at least 2 criteria: liquidity collect, break of structure, and inefficiency. Okay, let's check them out. As you can see, this is our first zone. We call it as an extreme zone because it was the start of the whole order flow. Okay, this zone changed character here and here, so this will be valid because it created inefficiency and swept liquidity. The next zone will be this one because it, as you can see, created inefficiency. It has a gap between the wicks and it broke structure, broke this structure. Okay, the next zone will be this wick zone because it created inefficiency, huge inefficiency, broke structure to the upside and collected liquidity from this region. As you can see, here's another zone, this small zone, because it created inefficiency to the upside, broke structure, collected liquidity. Price reacted on this zone here and just broke below a little bit. But after the broke below, price created this demand zone again, broke structure to the upside, created inefficiency, and it didn't collect any liquidity, but it will be a valid zone. After this, price broke structure to the upside here with this candle, created inefficiency, and swept liquidity from this region. Okay, let's move on. Welcome, this video will be about the inefficiency. What does the inefficiency mean? It means the gap between the wicks in an impulsive movement. If price moves rapidly, printing several candles, and the wicks between the candles doesn't meet, it will be inefficient. So as you can see, price is printing several candles here, and the wicks between the candles, so this one and this one, doesn't meet in the middle. So this gap between the price is inefficient. So basically, inefficiency means gap between the wicks. Okay, here you can see an example for an efficient price. As you can see, several candles has been printed and the wicks between the candles meet in the middle. So there's no gap in the price, there's no inefficiency in the price, so this one is efficient. Okay, but how can we actually use this to our advantage? When the market moves rapidly and leaves inefficiency behind, price usually fills the created gap to restore the balance. Assigning inefficiencies and combining them with supply and demand zones can make you avoid a lot of early entries and can save you from unnecessary losses. Okay, so let's see the example. Price is moving in a downtrend, as you can see. In this region, price created inefficient move. So there's a gap between the wicks. So this means there's imbalance, there's inefficiency. Above this inefficiency, you can find the supply zone right here because this supply zone created inefficient movement and broke structure through downside. Let's say price creates another pullback. And after the pullback, it creates another supply zone and breaks structure to the downside. But this supply zone has no inefficiency below, just like this. So price has a greater chance to levitate back up to this supply zone and react on this than reacting on this one. Because if there's inefficiency, it will work like a magnet. It will magnetize the price back up to that zone and fill up the gap between the wicks. So if you see something like this, one inefficiency and one efficiency, you will aim for the inefficiency because it has a greater chance to reverse the price than this efficient movement. So let's see the live example. As you can see, price is currently moving in a downtrend, so creating a series of lower lows and lower highs. Let's focus on this region. As you can see, price created a break of structure to the downside with this candle. After that, it created inefficiency, so there's gap between the wicks. This area needs to be filled. Price has a great chance to levitate back up to this supply zone, react on this supply zone, and continue the bearish trend. This is exactly what happened because price reacted on this supply zone, broke structure to the downside here. It's a break of structure and created another inefficient movement. So as you can see, inside of this supply zone, price created another supply zone, which is right here, because this supply zone caused the inefficient movement. So there's a gap between the wicks again, here and here also. So price has a really great chance to come and fill this inefficiency up before it continues the overall bearish direction. So as you can see, price the break of structure on the downside here again, but this is efficient because this week and this week meets. So there's no inefficiency in the price. So it has a greater chance to fill up this void here and react in the supply zone. And after the reaction on the supply zone, it can continue the bearish trend. Okay, so I want you to practice inefficiencies. I'd like to give a task for you. So mark all of the inefficient areas between this line and this line. So in this region. For this task, you will need an image editor program or just a TradingView. And you have to screenshot this image and copy and paste into TradingView. I would like to ask you to mark all of the inefficient areas, and I will just show you an example. For example, I see an inefficient area here. I just press my highlighter and mark it. I would like to ask you to do the same with all of the inefficient areas. I will give you 1 minute for this. Okay, so your time is over. And as you can see, I marked all of the inefficient areas between the red lines. So if you see a yellow highlight, that means we have an inefficient gap there. As you can see, on all of the yellow lines, we have an inefficient gap between the wicks. So the areas are inefficient. It will take some practice to notice all of the inefficiencies on a chart. So if you watch this video, I would like to ask you to open TradingView and just practice the inefficiencies and train your eyes to see them. Okay, see you in the next video. Hello, welcome in the next video. In this video, we'll talk about how to choose the best supply and demand zones. As you can see in this example, price is creating series of higher highs and higher lows. After the last high has been created, price did a pullback, and after the pullback, price broke structure to the upside with inefficient movement. So, how would you choose the best demand zone in this case? In order to find the best demand zone, you will have to find areas where IFC has been created. Okay, you will have to find the less recent candle before the inefficiency. Which is the less recent candle before the inefficiency? It's this downside candle. So as you can see, this downside candle was the less recent candle before the inefficient push to the upside. So in this case, this downside candle will be your right demand zone. You will expect some confirmation or long entry on this zone. But let's see what happens if the less recent candle before the inefficient push isn't the downside candle in the long example. So as you can see, price did a pullback, but the less recent candle before the inefficient push is an upside candle. You don't need to be scared. This will be your right demand zone again, because it doesn't have to be an opposite side candle. So yeah, in this case, you will choose the less recent candle again before the inefficient push to the upside. So once more, your right demand or supply zone will always be the last recent candle before the inefficient push. This is the #1 rule. Let's see another example. In this case, price is creating a series of higher highs and higher lows again. After the last high has been created and the pullback happened, price started to slow down and started to create efficient movements. As you can see, all of these movements are efficient. The inefficiency came into the market with these candles. So in this case, we won't choose the last opposite side direction candle, so this zone, because it didn't create any inefficiency. Which candle created the inefficiency? This one again. So the last recent candle will be your right demand zone or supply zone before an inefficient push. So always choose the last recent candle before the inefficient push and the break of structure. As you can see, this structure has been broken by this candle and by this inefficient push. So this will be your right demand per supply zone every time. So let's see a live example for the best zone selection and the inefficient push. So as you can see in this region, price created a pullback with this candle, and after that, inefficient movement happened by these 3 candles. Which zone caused the inefficient push? It was caused by this downside candle. So this will be our right supply zone. And as you can see, we have an upside candle before this candle, but this upside candle didn't cause the inefficiency. The inefficiency was caused by this supply zone, by this downside candle. And as you can see, after this candle, the inefficient push came into the market. So this will be our right supply zone. Okay, let's talk about the long examples. As you can see in this region, price is creating a series of higher highs and higher lows. Let's start from this region. As you can see, the inefficient push came into the market here. So we have inefficiency here. We will have to find the last recent candle before the inefficiency has been created. Which is that candle? It's this one. So this will be our right demand zone because it broke structure to the upside, it created inefficiency, and it swept liquidity from this region. So this will be a really strong demand zone. Let's see another demand zone. As you can see, an inefficient push happened here again. And before this inefficient push, price created a pullback. So this will be a downside candle before the inefficient push. So this will be another right demand zone because it broke structure to the upside again, created inefficiency, and actually created liquidity here, just above the zone. Okay, let's find another demand zones. So as you can see, price broke structure here to the upside, created inefficiency here. So we will have to find the last recent candle before the inefficient push. This candle is the last candle before the inefficient push. So this will be our right demand zone. As you can see, price broke structure to the upside here again. And we have inefficiency here. We have to find the last recent demand zone before the inefficient push and break of structure, which will be this one. And this goes on and on and on again. This is a really, really simple rule. You will always have to find the last recent candle before the inefficient push. Let's talk about the weak zones. As you can see, in this scenario, price is moving in a downtrend. After the high and the low has been created, price started to form pullback phase. This pullback phase is efficient, as you can see. After the pullback phase, price created a break of structure to the downside with inefficient movement. So these 3 candles are inefficient. This is the only scenario where you can't use the last recent candle before the inefficient push because this candle is already mitigated by the following wick. So in this scenario, you will have to use the wick as the supply zone because the orders are sitting on this candle, this wick, and not on the last recent candle before the inefficient push. So this is the only scenario where you can't use the last recent candle before the inefficient push. Just think logically. Where are the orders sitting? They are sitting on this wick. So the orders have been placed on this wick because this wick caused the inefficient push to the downside. This last recent candle by the inefficient push is already mitigated by the following wick. So once more, this is the only scenario where you can't use the last recent candle before the inefficient push. Okay, let's see a live example for this. Okay, so let's see the live example of the weak zones. As you can see, price is moving in a clear downtrend because it's forming highs, lows, lower highs, and lower lows. So let's just focus on this region. I will just zoom in. As you can see in this region, price has created inefficient move to the downside. So it's a really real inefficiency. Also, this inefficiency broke structure to the downside here. So it's a break of structure. Okay, what should we do in this case? Normally, we will look for a less recent candle before the inefficient push and the break of structure. And the less recent candle will be this one, because this candle is inefficient, this candle is inefficient, and this is inefficient. So the less recent candle will be this. But in this case, this candle has been already mitigated by the following candle's wick. So the orders are sitting on this wick and not on this candle, because this candle has been already mitigated. So in this case, this will be our right supply zone. Hello, welcome in this video. This video is about the mitigations. What is a mitigation? When price taps into a supply or demand zone that has not been tapped yet, it becomes mitigated from unmitigated. What does it mean? If you have a supply or demand zone, there are loads of orders sitting on those zones placed by algorithms, banks, and retail traders. When price taps the zones, the resting orders are getting picked up, so it's becoming mitigated from unmitigated. A zone can be only mitigated once because orders can be picked up twice, but the price can form another zone inside of the old one. But okay, that's enough of theories. We don't really want to overcomplicate things. Forex trading is hard enough, so let's keep the theories and analysis simple. Okay, let's see an example for the mitigations. Price is moving in an uptrend, so it's creating a series of higher highs and higher lows. If price moves in an uptrend, we are expecting the demand taps. Let's say this demand zone was created because it created inefficient move to the upside, broke structure, and swept or created some liquidity. So this demand zone will stay unmitigated unless price taps into this zone and collects all of the orders that are resting on this zone. If price steps into this zone, it will become mitigated. Okay, let's say price stepped into this zone, mitigated the orders, collected the orders, and after the mitigation, price created another break of structure to the upside, inefficient move, created or swept some liquidity. In this case, price will create another demand zone that will stay unmitigated unless price taps into this zone. If price taps into this zone, it will become mitigated again. This is how mitigations work. This is a demand chain. Okay, let's see a live chart example for the mitigations. As you can see, price is currently moving in a downtrend, creating a series of lower lows and lower highs. So if price is moving in a downtrend, we are expecting the supplies to be formed and the supplies to be mitigated. So if we see a downtrend, we will see supply zones and we will see the mitigation of these supply zones. So if price steps an unmitigated supply zone, it will become mitigated. So all of the orders were collected. Let's see the live example, and I will just play price forward. As you can see, price created inefficient movement to the downside. It broke structure here. So we will have a right supply zone, which is this one, because this candle created the inefficient movement and the break of structure. So right now, this zone is unmitigated unless price steps into this and mitigates the zone, so collects all of the orders. Let's see what happens. As you can see, price tapped this zone, so it became mitigated. Let's play price. As you can see, price broke structure to the downside again here and created inefficient movement, and the inefficient movement was created by this wick right here. Okay, we are expecting a tap of this supply zone now. Price tapped this supply zone, mitigated it, collected the orders. So right now we are expecting another break of structure to the downside. As you can see, another break of structure happened here. Another inefficient movement happened, and the inefficient movement was caused by this candle. Actually, we could use the upside candle before the inefficient movement, but this is a refinement. We'll talk about refinements in the later units. And the inefficiency was caused by this candle, and the break of structure was caused by this candle too. So this will be the right supply zone. This supply zone will stay unmitigated unless price comes back up and taps into this zone. So it will collect the orders and it will become mitigated from unmitigated. Okay, let's see what happens. As you can see, price mitigated the zone again, collected the orders, so this became mitigated. And this will go on and on and on. This is a supply chain, and this is a mitigation. So let's see another example. As I said earlier, zone can be only mitigated once because orders can be picked up twice, but price can form another zone inside of the old one. So I brought an example for this one. So as you can see, price is moving in an uptrend, creating inefficient movements to the upside and breaking structures. So this means we will have a right valid demand zone. Price came back down to mitigate this zone, collected the orders, and after the order collection, it created a change of character to the upside. So we will talk about change of characters later, but as I said earlier, if a change of character happens, price will automatically create a new zone. So this could seem like price created a zone and it mitigated that zone twice, and after the second mitigation, price blew up to the upside. But it didn't really happen because price created a new zone inside of the old one. Because price mitigated the old zone, and after a mitigation, it created a change of character. So it immediately created another zone. So this another zone, this new zone, will be inside of the old bigger zone. So this seems like it's a second mitigation, but it's not a second mitigation. It's a new zone mitigation. Okay, so let's see an example for that. How can we use the unmitigated and mitigated zones for our advantage? So as you can see, price is extremely bullish, creating a series of higher highs and higher lows. And price created this demand zone right here. This demand zone is valid because it broke structure to the upside, so it broke to the last structural point, created inefficient move, but it left unmitigated because price didn't come back down to mitigate and collect the orders. So we will have this zone as our turning point, and we are expecting some reaction on this zone. And after the tap of this zone and the mitigation, we will expect the reversal point, so change of character to the upside, and the continuation of the longs. Okay, price reached its high point here, and after the high point has been reached, price broke structure, change character to the downside. So as I said, change of characters will always create a zone. So this supply zone has been created, but it left unmitigated also, because price didn't come back up to mitigate this one. We will use this supply zone for our target point later. Okay, as I said, we are expecting the tap of this demand zone, mitigation of this demand zone, and reversal on this zone. Let's say price comes back down to this zone, mitigates it, and after a mitigation, it creates a change of character to the upside. And as I said, change of characters will always create a zone. So we have a change of character here. And don't worry, we will talk about the change of characters in the entry units. So we have a change of character, and we created another demand zone because the change of character will always create a demand zone or a supply zone. So as I said, we are expecting the continuation of the bullish trend. So price mitigated this big demand zone. And after the mitigation, it created a change of character, reaction on the freshly created demand zone. And after this, we can use the unmitigated supply zone. So this one for our target point. Hello, welcome in this video. We'll talk about the who's in control topic. This is one of the most important things to master in the supply and demand trading. Understanding if supply or demand is in control can help you to avoid a lot of unnecessary losses. How does this system work? It works based on simple mitigations. If price mitigates a demand zone, demand will take over control supply. If price mitigates a supply zone, supply will take over control demand. You always want to trade the controlling side of the market. So let's see an example for this. As you can see, price is moving in a downtrend here, creating a series of lower lows and lower highs. Price created a break of structure here with an impulsive, inefficient movement to the downside. So this means a supply zone has been formed here. Price didn't come back up to mitigate this zone, so this zone has been left unmitigated. Okay, after this, price created this pullback here, and after this pullback, broke structure to the downside again. This means we will have another supply zone, which is right here. After this, price broke through this supply zone, so this means demand took over control from supply. And as I said in the earlier videos, if a zone breaks, then an opposite side zone will be automatically created. So if this supply zone breaks, then a demand zone will be created automatically. Okay, price broke structure, mitigated this zone, broke structure to the upside again, created this fresh new demand zone, mitigated this fresh new demand zone again, broke structure to the upside again. This means we will have another demand zone, which is this one. This demand zone also left unmitigated. So after this movement, price did a small pullback here, and after this pullback, price broke structure to the upside again. This means we will have another demand zone, which is right here. But in this case, price tapped into this supply zone. If price taps into a supply zone, when demand is in control, and it rejects on that supply zone, supply will take over control from demand. Okay, let's see, we have two scenarios here. I mean, basically 3 scenarios. The first one, if price breaks through this supply zone without a rejection, demand will be control and supply did not take over control. The second one, price rejects on this supply zone and taps into this demand zone. So on the tap of this supply zone and rejection, supply took over control from demand. But if price taps into this demand zone and does a rejection on it, then demand will be control again. Okay, the third, if price rejects on this supply zone and breaks through this demand zone, supply will be fully in control and the new supply zone will be formed because, as you know, if a zone breaks, then an opposite side zone will be automatically formed. So a supply zone will be formed here and supply will take over control from demand fully. Okay, let's see a live example for the who's in control topic. We have a supply zone up here because let's say it broke structure to the downside with this inefficient movement. After the structure breaking movement, price did a pullback and created liquidity here, which is double bottoms. After this, price broke structure to the downside with this inefficient push, as you can see. So we have all the 3 criteria in order to form a valid supply zone. So first criteria, price swept liquidity. Second, it broke structure. Third, it created an inefficient move. So we have a valid supply zone, which means supply is in control. Okay, after this, price tapped into this demand zone and had a strong rejection in it, which means demand took over control from supply. But it isn't a full control because, as you can see, we still have this supply zone up here. And if price taps into this supply zone and reacts on it, supply will be in control again. If price breaks through this supply zone, demand will be fully in control. But in this region between the demand and between the supply zone, demand will be just partly in control. Okay, as you can see, demand was partly in control, reacted on this supply zone, had a rejection, which means supply took over control from demand again. After this, price broke through this supply zone and created a demand zone that did a supply breaking movement. This means demand is fully in control now. But we have a supply zone up here, which was the extreme of the move because it started the whole bearish order flow. And the price actually tapped this supply zone, which means supply took over control from demand again. And as you can see, we have this last demand zone right here, which created the inefficient movement and the break of structure to the upside. And price broke through that zone with this movement, with this inefficient movement after this supply tap. So what do we know about zone breaks? If a zone breaks, then an opposite side zone will be automatically created. So if a demand zone breaks, which is here, a supply zone will be created, which is here. Sorry. So this week started the inefficient movement to the downside and the break of structure. So this means this week will be our right supply zone. As you can see, price came back up to this supply zone, mitigated this supply zone, and reversed the price again. So this means supply is in control in this region. And this goes on and on again. Okay, as I said in the beginning of the video, you always want to trade the controlling side of the market. So supply was in control because it was creating series of lower lows and lower highs over and over again, forming supply zones. But as soon as price stepped into demand zone, and this demand zone had enough power to reverse the price and create a change of character, you will want to see demand trades because demand did a change of character to the upside and took over control from supply. You will want to trade the controlling side of the market, which is demand in this case. So you will have room between this supply zone, which was the last supply zone before the demand tap. So you will have room between this supply zone and this demand zone to trade long side opportunities. And as soon as price steps into this supply zone, you will want to see short side opportunities. But if price doesn't give you the right opportunity to execute short trades, so supply trades, and it breaks through this supply zone, you will want to trade the controlling side of the market again, which is demand in this case again. And you will also have a room between this demand zone and this supply zone to execute long trades. So yeah, you always want to trade the controlling side of the market. This is one of the most important things in supply and demand trading to master, to understand what is in control and where you can execute the trades and what can be your TP. And your TP will be always the unmitigated supply or demand zones. Hello, welcome in the next video. This video will be about when should you wait for the confirmation entry and when can you use the risk entry. Okay, let's begin. You should always check if price is coming from an unmitigated zone or not. As I said in the previous video, you want to trade the controlling side of the market. If you are waiting for a demand trade, but price is coming from an unmitigated supply zone, supply is in control, and you can't execute a demand trade without a confirmation because there could be a high chance for you to get stopped out. Okay, let's see an example for when can you use risk entry and when should you wait for confirmation entry. As you can see, price is moving in a downtrend here, creating series of lower lows and lower highs. Supply was in control because supply was formed continuously, but price stepped into a demand zone. And after the demand test, price broke through the last supply zone and created a change of character to the upside. And as I always say, if price breaks through a zone, an opposite side zone will be automatically created. So price broke through a supply zone, so a demand zone was formed. After the tap of this freshly formed demand zone, price created a break of structure again to the upside with inefficient movement. Okay, after this, if you want to execute a demand trade here and follow the trend, you have three possible scenarios. If price taps into a supply zone, comes up here, reverses, then supply will be in control again, and you can't execute a demand trade without any confirmation because you always want to trade the controlling side of the market. And if supply is in control, you can't open a demand trade because there will be a high chance for you to get stepped out. So in this case, you should always wait for confirmation entry. We will talk about confirmation entries in the next unit. Okay, the second scenario, if price reverses before this supply zone and does not tap into any supply zone, then you can open a risk entry here without any confirmation because demand is still in control and you can easily target the next unmitigated supply zone after the tap of this demand zone. So once more, if price reverses before this supply zone, you can easily open a risk entry here and target the next unmitigated supply zone because price did not tap into any supply zone, so demand is still in control. So the third scenario is if price breaks through this supply zone and does not tap into any supply zone, so demand will stay in control, then you can execute a demand trade again on this zone because demand is fully in control because it broke through the last supply zone. So these are the three possible scenarios. So once again, first one, price taps into this supply zone, reverses, then you can't open a risk entry here because you should wait for a confirmation entry because supply is in control. The second one, if price reverses before the supply tap, then you can easily open a risk entry here because demand is in control and price did not tap into any supply zone. And the third one, if price breaks through this supply zone, demand will be fully in control and you can easily open a risk entry on the demand zone. Okay, let's see a live example for this. Okay, so let's see a live example for the risk and confirmation entries. So as you can see, price was moving in an uptrend, creating a series of higher highs and higher lows, higher highs, higher lows. And in an uptrend, price will form demand zones. So we have this really valuable demand zone right here because it created huge inefficient push to the upside. This inefficient push created a breakout structure and swept some liquidity from this region and created liquidity here just above the zone. After this, price did a pullback here. And after the pullback, it created a breakout structure to the upside again from this demand zone. But actually, I refined this zone on the 5-minute chart because we are currently on the 15-minute chart. But we'll talk about refinements in the next video. Okay, so we have this demand zone that created the last breakout structure to the upside, and this demand zone pushed the price up to the supply zone. Because we have this supply zone up here, because price was moving in a downtrend, and now price is in the pullback phase in the uptrend. So it's on the way up to tap the supply zone. So after supply tap, supply took over control from demand. So you can't open a risk entry on this zone or this zone. You will have to wait for a confirmation entry, some change of character, and after you can open a demand trade also on this zone too. So let's see what happens. Price reacted on this supply zone, as you can see, strong rejection. So supply is in control. If price breaks through this zone, supply will be fully in control because it broke through the last demand zone. So after a zone breaks, an opposite side zone will be created. So if this demand breaks, supply zone will be created. Let's see what happens. Very strong momentum. As you can see, price broke through this demand zone. So a supply zone has been created. And this supply zone caused the order flow that led to a break of structure and change of character to the downside, and it broke through the last zone. So we can't open a risk entry here because we have to wait for a confirmation entry. Let's see what happens. Supply is fully in control. So supply is still in control. Let's see what happens. Okay, price tapped into the supply zone, as you can see, and had a reaction and some rejection. So this means demand is in control now. And we have this supply zone up here that caused the tap of this zone with inefficient push, as you can see, and break of structure to the downside. And actually it swapped some liquidity from this region too. So this is a really valuable supply zone. If price taps into this supply zone and rejects on it, supply will be in control again. But if price breaks through this zone, demand will be in control again, and the demand zone will be formed because it broke through an opposite side zone. Okay, let's see what happens. As you can see, price tapped into this zone and had a reaction. So supply is in control now. If price breaks through this zone, demand will be in control and the demand zone will be formed. Okay, price broke through a supply zone. So demand zone has been formed here, as you can see. We have this demand zone right here. Let's just extend the zone and play price forward. So actually you can open a long trade on this zone because this was the confirmation entry. Price broke to the last supply zone, so demand has been formed. So a confirmation entry has been happened, and we can target the next unmitigated supply zone, as I said. So this will be our target point. Let's see what happens. Price tagged us into the trade, had a reaction. So demand is in control, as you can see. Price reacting strongly on this demand zone. So we are in the trade, creating series of higher highs and higher lows, respecting demand zones over and over and over again. I will just extend these zones. Let's see what happens. TP hit. So as you can see, this is how can we use the risk and confirmation entries, knowing the fact who's in control for our advantage. And this is a really, really strong weapon. So you have to master it and master everything about the control side, because you always want to trade the countering side of the market. Okay, meet you in the next video. Welcome. In this video, we will talk about the refinements. What do we call a refinement? When we have a higher time frame supply or demand zone, we want to check if we can make that zone smaller on the lower time frames. We will use two types of refinements, the 4-hour to the 50-minute and the 15-minute to the 5-minute. The 50-minute chart or the 50-minute time frame is moving in a downtrend, creating a series of lower lows and lower highs. This means we will have supply zones. Let's say the upside candle of this movement created the inefficient move to the downside and the break of structure. So we will have a right and valid supply zone. If we switch to the 5-minute chart, inside of this 15-minute supply zone, we will find a much smaller zone because the 5-minute candle before the inefficient push will be significantly smaller, and we can use this zone as our 5-minute refinement. So if we correlate the time frames, we will have this bigger 50-minute zone, and inside of that bigger 50-minute zone, we will have a much smaller 5-minute zone. So this is what we call refinements. Okay, we are on the live chart. I usually do two types of refinements. The first one is the 4-hour zone refinement on the 15-minute, and the second one is the 15-minute refinement on the 5-minute. But if I refine the 4-hour zone on the 15-minute, I just keep it that way, and I won't refine it again on the 5-minute. So I only refine those 15-minute zones on the 5-minute, which were not refined from a 4-hour zone. Okay, as you can see, currently we are on the 50-minute chart, and I will show the 50-minute to the 5-minute refinement first. Price was moving in an uptrend here, creating a series of higher highs and higher lows. After this, price changed character to the downside with these two inefficient candles. So we have the first POI on the 50-minute, this one, because this is the less recent candle before the inefficient push and the change of character. So I mark this zone out. If I switch to the 5-minute chart, you will see that inside of this 50-minute POI, this big box, we will have a much smaller box, this one, because the inefficient push on the 5-minute started from this candle. So we almost halve the size of this zone. With these refinements, you can have much smaller zones, and you'll have a more precise area of the possible turning points or target points. So if you were in long trades, for example, from here, you will target this area, this 5-minute refinement, and not the 50-minute, and you will have a higher risk-reward ratio. And if you are waiting for a turning point, you will aim for this 5-minute refinement and not on the 50-minute, because you know that inside of the 50-minute POI, you will have a smaller 5-minute POI, and you will wait for a reverse point on this 5-minute POI. This is the power of the refinements. Let's see this on the 4-hour to the 50-minute chart refinement. Before we continue with the 4-hour to the 50-minute refinement, I want to show you what happens if you get two unmitigated 5-minute zones inside of the 50-minute zone. So if you see two unmitigated 5-minute zones inside of the 50-minute zone, you just want to keep the unrefined 50-minute zone. And if one of the zones are mitigated, you can use the other 5-minute zone as the refinement. So as you can see, price is moving in an uptrend here, creating a series of higher highs and higher lows. We will have this 50-minute zone here because it created a breakout structure to the upside with an inefficient movement. So we can safely mark out this 50-minute zone. If you want to refine this 50-minute zone on the 5-minute, you will see two different 5-minute zones inside of this 50-minute. The first one is down here. The second one is up here. The first one has been already mitigated by price. So this means you can safely use the upper one as the 5-minute refinement. But if price didn't mitigate the first one, so it has been left unmitigated, you can't use double zones. You will have to use the full 50-minute zone as your demand zone. So you can't refine it. Okay, let's see the 4-hour to the 50-minute chart refinement on the live charts. You can also apply the double zone rule on this one. So let's see an example. As you can see, price created this demand zone right here. It created an inefficient push to the upside, break of structure here, change of character here, liquidity is here. So this is a really valuable zone. Okay, let's see the refinement of this zone on the 15-minute chart. Let's find that zone. As you can see, this is that 4-hour zone. And inside of this 4-hour zone, you will have two different demand zones. The first one is up here. As you can see, this created inefficient push to the upside. Here, break of structure and liquidity sweep. So we have this first 15-minute POI inside of the 4-hour. We have a second one down here, as you can see. This one, because it also created break of structure to the upside with an inefficient move and liquidity sweep. But this zone has been already mitigated by this movement. So this means you can safely use the upper zone, because as I said, if you get two zones and one of the two zones is mitigated, you can safely use the other one. So in this case, the other one is this one. Okay, you will want to see some rejection or reaction on this zone inside of the 4-hour POI. Let's just extend this zone and search for a reaction. As you can see, price perfectly tapped this zone, perfectly tapped it with this wick, and after the tap of this zone, it rejected and reversed the price to the upside. So this is the power of the refinements, because as you can see, price has already tapped this zone, the 4-hour one, but it didn't mitigate the full zone and didn't mitigate the 50-minute zone. So it had to come down to mitigate the 50-minute zone inside of the 4-hour. This is the true power of the refinements. Hello, welcome to the next video and the next unit. We will talk about the knowing the market direction using the controlling side. One of the most important things in trading is to know the overall market direction on the higher time frame and combine this knowledge with the lower time frame. So if the 4-hour time frame moving in a bullish trend, creating highs and lows and respecting demand zones and breaking through supply zones, our overall main trend will be bullish. This trend will look like this on the 50-minute chart. On the first leg of the 4-hour, on the 50-minute, price will respect demand zones over and over again. And as soon as price reaches its high point and turning point, price will turn into bearish on the 15-minute chart, and it will respect supply zones over and over again. But as soon as price steps into the 4-hour demand zone, which is down here, this is the 4-hour demand zone on the 50-minute. So price steps into this zone on the 15-minute chart. We can expect some reversal point, and we will see demand trades over supply trades again. So price will create this second leg, and on this second leg, the 15-minute chart will create demand zones over and over again. And if price reaches its second turning point and reversal point, we will see supply trades over and over again, over demand trades. Price steps into the second demand zone, which is down here. The second demand zone, the second 4-hour demand zone will look like this on the 50-minute. And if price steps into this zone on the 50-minute chart, we can expect a reversal point again, and we can expect demand trades over supply trades again. Okay, so that's a live example. As you can see, in this region, on the 4-hour, price is creating a series of higher highs and higher lows, creating demand zones and breaking through supply zones over and over again. So we will know that the overall direction is bullish. Okay, as you can see, I marked out the demand zones in this region. These demand zones created inefficient push to the upside, broke structure, and swept some liquidity. So these are valuable demand zones. As you can see on this demand zone, huge inefficient push came into the market, break of structure to the upside, and liquidity is free from this region and also from this region. We have this last demand zone here. As you can see, this was the last candle before the inefficient push to the upside and the break of structure and the liquidity sweep. So we will have this last 4-hour demand zone. We will expect some reaction on this zone. And after a tap of this zone, we can expect a reversal point, change of character, then the continuation of the overall trend. So let's switch to the 50-minute chart. And as you can see, this was the 4-hour zone that created the last 4-hour high. On the 50-minute, the pullback already started. We have the last candle. And let's see what happens. We can actually refine this zone on the 50-minute to this week here. Sorry, bear with me. So we can refine this zone to this week because this was the last unmitigated demand zone on the 15-minute chart before the inefficient push and the break of structure. All of the zones above this zone. So this one is mitigated by this candle. This one is mitigated by this candle. So this is the only unmitigated zone inside of the 4-hour POI. So we will use this zone as our refinement. This means we will know that if price steps into this 4-hour zone, we will expect the tap of this zone also, because the only unmitigated 15 zone inside of this zone is this one. Okay, so as you can see on the 15-minute chart, the structure looks like this, creating a series of higher highs and higher lows, creating demand zones over and over again. I will just move it here. You can see it's creating demand zones, respecting demand zones, and creating a series of higher highs and higher lows. On the 4-hour, this movement just simply looks like this. Let me just switch back to the 4-hour chart and you will see that. I will just remove these arrows. So as you can see, the 4-hour leg looks like this, just a straight upside candle or candles. Okay, but on the 50-minute, it is creating a series of higher highs and higher lows, demand zones, and breaking through supply zones. So as I said earlier, if price reaches its high point and the turning point, price will create a series of lower lows and lower highs and creating supply zones and breaking through demand zones on the 15-minute chart. But on the 4-hour chart, this pullback will look like just a simple leg into the 4-hour POI. Okay, so I will just play price forward. And you can see that price created a series of lower lows and lower highs. I will just map the structure out again. As you can see, we have the high points, low points, and supply zones. So this is how this structure looks like on the 50-minute, creating supply zones over and over again, respecting those supply zones and breaking structures to the downside. I will switch back to the 4-hour and I will show you how does this look like. So as you can see on the 4-hour, it's just a simple one candle to the downside. And on the 4-hour, this is the structure. On the 50-minute, this is the structure. So you will know that the overall direction is still bullish because price respected this demand zone. As you can see, price almost tapped the down area, the less unmitigated 50-minute POI. It almost tapped that zone, so we will expect the tap of this zone. I will just play price forward again. See what happens. Okay, price is really, really close to this zone. And as you can see, the tap of this zone happened. We can also expect some liquidity sweep here because we have a bunch of liquidity in this area. And I will talk about liquidity sweeps in the next unit. Price has a great chance to sweep all of this liquidity before the reversal. So let's see what happens. Price swept the liquidity to downside, as you can see with this movement. And after a liquidity sweep and the mitigation of this 15-minute POI, this 15-minute demand zone, price reversed the price to the upside with change of character here. And as I said, after the 4-hour demand tap, we'll expect the same order flow, the bullish order flow on the 15-minute chart, so creating series of higher highs and higher lows. So let's play price forward again. As you can see, price is creating series of higher highs and higher lows. I will just map the structure out again. Highs, lows, highs, lows, highs, lows. And this is how the 50-minute structure looks like, creating highs and lows, creating demand zones over and over again, respecting demand zones and breaking through supply zones. But on the 4-hour chart, this 50-minute movement will look like just a simple leg. Let me just switch back to the 4-hour chart. So as you can see, on the 4-hour, this movement is just a simple leg. Okay, so let's see what happens if the 4-hour chart reaches its high point and reverse the overall trend. So as you can see in this region, price was moving in an uptrend, creating series of higher highs and higher lows, creating demand zones, breaking through supply zones. But after the high point has been reached, price reversed, and the 4-hour chart reversed the trend also. So from bullish, it turned into bearish, and the 4-hour chart turned into series of lower lows and lower highs, creating supply zones and breaking through demand zones. So creating supply zones, breaking through demand zones, as you can see. And if this happens, the 4-hour trend will change into bearish. So it will look like this. I will just mark the structure out again. So as you can see, it's creating a series of lower lows and lower highs. And the 50-minute structure will look like this. Because it's bearish, these are the 4-hour legs. This is one upside leg. This is one downside leg. This is one upside leg. This is one downside leg. And on the 50-minute chart, it will also look like on the upside legs, creating series of higher highs and higher lows. And on the downside leg, it will create series of lower lows and lower highs. And the main trend turned into bearish from bullish. So you will want to trade the countering side of the market again, which is bearish. So short trades are in control. It means supply is in control. Okay, let's combine more time frames together. So if the 4-hour structure and trend is bullish, it's creating series of higher highs, creating demand zones and breaking through supply zones. The 15-minute will look like this, as I said in the earlier video. So on the first leg of the 4-hour structure, the 15-minute will create series of higher highs and higher lows and demand zones. The second leg of the 4-hour, so the pullback phase, it will create lower lows and lower highs and supply zones. And the third leg, it will create a series of higher highs and higher lows again and demand zones. Okay, let's combine the 15-minute time frame and the 1-minute time frame together. So let's focus on the last leg of the 4-hour. So on the last leg of the 4-hour, it's bullish on the 15-minute, creating series of higher highs and higher lows. And let's focus on this region of the 15-minute chart. As you can see in this region, price created upside push, break of structure, inefficiency, and the demand zone. After a demand zone has been created, price came back to this zone and created a new high. On the 15-minute, it will look like just 3 simple legs. But on the 1 minute, it will create a series of higher highs and higher lows. And after the 15-minute high point has been reached, the 1 minute chart will reverse and it will create a series of lower lows and lower highs down to this 15-minute demand zone. And as soon as price taps this 15-minute demand zone, here and here, so this zone is the 15-minute zone drew on the 1 minute. So as soon as price taps this zone, we can expect some reversal, change of character to the upside, and the continuation of the original order flow, which is bullish. So this is what we call the expectational order flow. Okay, let's see how can we combine all of the time frames together and use them for our advantage. As I said, the 4 hour is bullish, creating highs and lows, creating demand zones and breaking through supply zones. So the main trend is bullish in this scenario. So this leg is the main trend, this leg is the counter trend. The main trend on the 15-minute will look like this, creating a series of higher highs and higher lows. And the counter trend will look like this, creating lower lows and lower highs until it taps into a 4 hour demand zone, and the 4 hour demand zone reverses the price for the main trend again. Okay, let's focus on this region of the main trend on the 15-minute. So price is creating demand zones over and over again. A new demand zone has been created here, and this demand zone broke structure to the upside with inefficient movement. This region, as I said, will look like this on the 1 minute chart, and we can expect the tap of this 15-minute zone. So this is the 15-minute zone on the 1 minute chart, and we can expect the tap of this zone. And after the zone has been tapped, we can expect the reaction and the reversal. So the continuation of the whole order flow, the whole bullish order flow. But before the zone tap happens, price will reverse on the 1 minute, and it will create a series of lower lows and lower highs down to this region. And after this region has been tapped, price will reverse the price and create a change of character. As I said, we'll talk about change of characters in the entry notes, create a change of character. And after the change of character happened, we can happen in long trade because we know that the overall direction is bullish. So it's safe to enter a bull trade on the 1 minute chart, knowing the higher time frame direction. So let's see another scenario before we take a look at the live examples. So price is in a bullish trend again, creating highs and lows and creating demand zones. After this demand zone has been created after a breakout structure and the inefficient movement, the 4 hour chart and the 4 hour price tapped into this zone and reversed the price and created a new high. This tap of the zone and this movement will look like this on the 15-minute chart. So the first upside leg, pro trend leg, will look like this on the 15-minute, and the second downtrend, so the counter trend leg, will look like this on the 15-minute chart, creating a series of lower lows and lower highs. Price tapped into this 4 hour demand zone. So this will be the 4 hour demand zone on the 15-minute chart. Price tapped into this zone, and after it broke through the last high point, did a change of character and tapped into this 15-minute demand zone and reversed the price. And this movement will be this leg. This movement will create a new high. Okay, let's break down this step of the zone on the 1 minute chart. So after the 15-minute change of character and the 15-minute demand zone has been created, price tapped into this zone, and this upside movement will look like this on the 1 minute chart, and this downside movement will look like this on the 1 minute chart also, creating a series of lower lows and lower highs. So after the tap of this 15-minute zone happened, here also on the 1 minute, price will change character on the 1 minute also. So break through the last high point, change of character, it will create a demand zone. And after the change of character, you can mark your demand zone out, hop in a trade on this demand zone, so hop in a long trade. And you can write the expectational order flow, which is this one, because it's bullish in this case. Welcome to the next video. We will talk about what is breakout structure. When market is moving in a trend, which could be bullish, which is this case, or bearish, which is this case, it will create breakout structures. It will create both to the upside in the bullish trend. So these are upside breakout structures in the bullish trend, and it will create downside breakout structures, which is this one in the bearish trend. Okay, so market usually moves like creating a series of lows, highs, higher lows, higher highs, higher lows, higher highs in the bullish trend, and it will create highs lows, lower highs, lower lows, lower highs, lower lows in the bearish trend. Let's see the bullish example. If price breaks through the last high point, which is this one, I will just draw it instead. So if price breaks through the last high point, which is this one, it will create a break of structure to the upside and will create a new high. After this, price will create a pullback. And if it doesn't break below the last low point, the last higher low point, it will respect the structure and the trend can continue. And after this, price will create a break of structure to the upside. So it broke through the last higher high point. It created a break of structure on this line. So this will be our new high until the pullback happens. So let's say a pullback happens. It creates a pullback. It respects the last higher low. It doesn't break below this low. So the trend can continue. Price will create a new higher high here, break of structure to the upside, and the trend can continue. This is the bullish trend creating a series of higher highs and higher lows. The short example is the same. Price has a high point and a low point. This is the high point, this is the low point. If price creates a pullback and respects the last high point, it can continue the bearish trend and create a break of structure to the downside. So here's a break of structure to the downside. After this, price creates a pullback. This means we will have a new lower low. This is our new lower low. If the pullback respects the last lower high point, which is this one, so it doesn't break below it, it will create a new higher lower high. This will be a new lower high. And after this, price can create the bearish trend, break structure to the downside, create another boss here. And if the pullback happens, if it respects the last lower high, which is this one, it can continue the overall bearish trend. So that's a live example for this. As you can see, in this region, price is moving in an uptrend, creating a series of higher highs and higher lows. I will just map out the structure. We have this low point here. We have this high point here. A pullback happens, so a lower, higher low has been created. After this, price broke structure to the upside. A high has been created, a new higher high. After a pullback, it created a new higher low, new higher high, new higher low, new higher high, low, high, low, high, low, high. So I will just duplicate this line, and you can see that price is moving in a clear uptrend, creating a series of higher highs, higher lows, higher high, higher lows. And after every high has been broken, price will create a break of structure to the upside. So this high has been broken, break of structure to the upside. This high broken, break of structure to the upside. This high broken, break of structure to the upside. And you can also see this in the live chart. So as you can see, for example, in this area, break of structure happened. The last high point has been broken. So this is our break of structure. This is our high, that high broken, break of structure to the upside. This is our high, high broken, break of structure to the upside. High, high broken, break of structure to the upside. And this goes on and on. So this is our bullish trend. And as you can see, after this, price turned into a bearish trend and changed character here. We will talk about change of characters in the entry units, as I said. So change of character happened here. After this, price turned into a bearish trend, creating a series of lower lows and lower highs. I will just map out the structure again. We have this high point here, a low point, lower high, lower low, 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 lower high, and this goes on and on. I will just duplicate this again, and as you can see, price is moving in a really clear downtrend, so bearish trend. If this if this low is broken, price will create a break of structure to the downside with this movement. If this low is broken, price will create a break of structure. If this low is broken, price will create a break of structure, and this goes on and on and on again. This is the break of structure. Now let's see how can we identify the break of structure. Okay, so let's see an example for the body and the wick closures. So in this region, price is moving in an uptrend, creating a series of higher highs, higher lows, higher highs, higher lows. This was our last high point. So if this high point breaks, break of structure will happen to the upside. This is our last higher low point. If this breaks, a change of character will happen to the downside. Okay, so on the last higher high point, we have this candle. with a wick and the body. Price did a pullback, created a new higher low. After this, price started to try to break through this high. Okay, when will this be a break? When do we call it a break? If price breaks through this last high point, so this line is the last high point. So if price breaks through this with a wick, it won't be a break of structure. We only count break of structure if the candle closes above with the body. So it has to close above this last wick with a body. This is what we call a wick to body closer. If price just closes above with a wick, it won't be a break of structure. It could be a liquidity sweep. We will talk about liquidity sweeps in the next unit. So if it closes above with this candle and not just a wick, that will be a break of structure, and we can mark this as a break of structure to the upside. After this, price can create a new low, new higher low. And if it tries to break above this high again, it will has to create a body closer again and not just a wick. Sorry, let me just duplicate this candle, duplicate the wick. So I mean, duplicate the wick, yes. So if this candle closes above this last higher high with just a wick, then it won't be a break of structure, because if the wick closes above, that is not a break of structure, it has to close above with the body. Okay, so let's see another live example for the closures. So as you can see, this is the same example as last time. Price is moving in an uptrend, creating a series of higher highs, higher lows, higher highs, higher lows with break of structures. Okay, let's focus on this region. And you will see that price created this last high here. And after it created a pullback to this region, I will just mark this as the high point. And until this high breaks, it won't be a break of structure. So as you can see, we have this wick here. That's our last high point. And price tried to break above this high, but it could only break above with a wick on this candle and the break above with a wick on this candle. So it won't count as a break of structure. But as you can see, this candle and this candle closed above on this high with a body. So it's a full body closure. So this will count as a break of structure. So basically, this upside candle created the break of structure to the upside. Okay, so in this region, this will be our new high. Until this high breaks, it won't be a break of structure. Price broke above with a body, closed above with a body on this candle, so it will be a valid break of structure on this line. Price did a pullback here, and as you can see, I will just zoom in and mark the last high point. This was the last high point, so until this high breaks, it won't be a break of structure. As you can see, price started to form a pullback here, and after the pullback on the fourth candle, price tried to break above this high, this weak high, but it only wicked above the high, so it didn't close above with the body, so it won't be a break of structure. And that's why I said it's so important to memorize that it has to close above with the body, because as you can see, it wicked above, but after the wick above, it reached deeper areas, so it wasn't a break of structure. The real break of structure came into the market with this candle, because this candle closed above the last high with a body. So this is our real break of structure line. Hello guys, welcome to the next video. We will talk about the weak and the strong structural points. So actually, what do we call a strong point? In a bullish example, if price breaks structure to the upside, it will create a strong low. So as you can see in this example, price is moving in an uptrend, breaking structures to the upside. Price broke structure here. So this means it created a strong low. This will be our strong low. Price created another break of structure here. So this means it created a new stronger low, which will be this one. In a bearish example, if price breaks structure to the downside, it will create a strong high. So in this example, price is moving in a downtrend, creating a series of lower lows and lower highs. Price broke structure to the downside here. This means it created a strong high. This will be a strong high point. It created another break of structure here. So this means it created a new strong high, which will be this one. So these are the strong highs. These are the strong lows. Okay, but what do we call a weak high? Weak high or weak low? In a bullish example, if price fails to break below the last strong low, it will create a weak high. So we have this strong low here because it broke structure to the upside here. And after the break of structure and the strong low has been created, price started to form a pullback on this leg. If this leg fails to break below the last strong low, which is this one, so it fails to break below this line, it will create a weak high. And as soon as this weak high breaks, it will create a strong low again, which is this one. So as you can see, we had this structural low here. Let's say this is a strong low. Price created a pullback, couldn't break below the last strong low. So this means this will be a weak high. We had this strong low right here. Price failed to break below this strong low. So this means this will be a weak high. Okay, in a bearish example, if price fails to break above the last strong high, it will create a weak low. The concept is the same. We have this strong high here because it broke structure to the upside. After the strong high and the breakout structure has been created, price started to form a pullback. And this pullback, this leg, failed to break above this strong high. So this means this will be a weak low. Okay, so let's see what happens if price breaks through the last strong low in a bullish example. So as you can see, price created this last right here, and this high had enough power to break below this last strong low. So this means an opposite side zone will be created. So if a strong low has been broken, a strong high will be automatically created. And the concept is the same on the bearish example. If price breaks through the last strong high, which is this one, so price breaks through the last strong high, it will automatically create a stronger low. So just memorize this. If price breaks through a strong structural point, the opposite side strong structural point will be created. Okay, so let's do another example. As you can see in this case, price is moving in an uptrend, creating a series of higher highs and higher lows. This strong low has been formed because it broke structure to the upside and broke the last structural weak point. So this proves this low will be strong. I will just mark it with this line. So this will be our strong low line. Okay, after this, price created this weak high because this pullback movement couldn't break below the last strong low. So this proves this high is weak. After this, price started to form a main trend movement and tried to break above this last weak high and try to break structure to the upside, but it couldn't break structure and couldn't break the last weak high. So this proves this point, this low will be weak. If price breaks through this point, this weak high, and breaks structure to the upside, this low will be strong, but as you can see, price couldn't break above, and instead of breaking above, it broke through the less strong weak low with this weak high. We have two scenarios here. Actually, price is moving in this range, so between this high and between this low. As soon as price breaks through this last weak high point, a strong low will be formed. So as you can see, this low broke through the last weak high point, so this proves this low is strong. The second scenario is if price breaks through this last strong low point, this high will become strong from weak. So if price breaks through the last strong low point, this high became strong from weak. Okay, I actually want to give you a task to complete. I want you to draw all of the strong and weak points on this structure. I will give you 30 seconds for this, and the clock starts now. Okay, so the time is over. Let's see if you did it right. We have this first strong high here because this first strong high broke below the last weak low and broke structure to the downside here. This low will be weak because this low couldn't break above the last strong high. This proves this is weak. This high will be weak again because this high couldn't break structure to the downside and couldn't break the last weak low. So this is a weak high. This will be weak low again because this low couldn't break above the last strong high. So this proves it can't break structure to the upside. It can't change character to the upside. It can't break above the last strong high. So this means this is weak. This will be strong because this high could break this structure and this structure to the downside and broke this low and this low. So this proves this is really strong. This is a really, really strong high. After this, this will be weak because this low couldn't break above the last strong high. So this is weak. After this high will be weak again because this high couldn't break below the last low and couldn't continue the overall structure. So this will be weak. This low will be strong because this low could break above the last high point. So this proves this is strong. I hope you did it well. See you in the next live example. Okay, so let's do live example. As you can see, in this region, price is moving in an uptrend, creating a series of higher highs and higher lows, breaking structures to the upside, respecting the structural lows. So let's focus on this region first. As you can see, price broke structure here to the upside with an efficient movement. So this means price broke through the last weak structural high, which was this one. So this means price created a new strong low, which is here. After this, price started to do a pullback here, but this pullback didn't have enough power to break below the last structural low, the strong low. So this means this high will be weak. After this, price broke through this last weak high, so break of structure and break of the weak high. This means price has created a new strong low, which is this one. After this, price reached this point, started to do a pullback again here, but this pullback couldn't break below the last strong low, which is this one, so it couldn't break below this line. So this means this is a weak high. After this, price broke structure to the upside here, broke the last structural weak high. So this means it created a new strong low, which is this one. This is our last strong low. If this strong low breaks, so if this strong low breaks, I will just draw a line here. Then a new strong high will be created. So as you can see, price could break below this last strong low. So this means an opposite strong zone has been created, which is a strong high. After this, price did a pullback to the upside here, but couldn't break above the last strong high, which was this one. So as you can see, it couldn't break above. So this means price created a new weak low, which is this one. I will just mark it with a dotted line. This is our new weak low. After this, price created a new strong high because it broke structure to the downside here. As you can see, it broke the last weak low with an efficient movement. So this means price has created a new strong high. After this, it created a pullback again. I will just delete this line from here and remove it to here. So this is our last strong high point, structural point. If this point breaks, then a new strong low will be created. If price can break through this line, then a new weak low will be created. So as you can see, price did a pullback here, couldn't break above this line. So a new weak low has been created. So I will just, why can't I draw it? So I will just mark it here. Okay. After this, price broke through the last weak low, as you can see here, with an efficient push and break of structure. So this means a new strong high has been created. And I can grab it again. Okay, this is our new strong high. If price breaks through this strong high, then a weak strong low will be created. As you can see, price couldn't break above this high. It just tapped the line perfectly. So this means this is a new weak low, this one. After this, price broke structure to downside here with this movement. So this will be our new strong high. And this goes on and on and on and on again. This is the easiest way to map out the structure. But let's see an example. In this region. So in this region, as you can see, this was the last weak strong high on this one. And after this, price started a pullback. This pullback couldn't break above this high, as you can see. So this means this low will be weak. So this is a weak low. After this, price started to do a main trend movement to the downside, and it couldn't break below the last weak low. So this means this will be a weak high. So this is a weak high. After this, price created a new pullback from this region. It did a pullback again to the upside, and this couldn't break above the last strong high. It just tapped the line perfectly, but it couldn't break above. So this means we will have a new weak low here. This is a new weak low. And after this, price couldn't break below the last weak lows here and here. So this means this structural point here, so this whole structural point here is a weak high. So these taps are weak because, as you can see, it couldn't break below the last weak low and this weak low. The last push came into the market from this candle and this structure. And as you can see, this high could break below the last weak low. So this means this is the strong high. So yeah, these were the live examples. See you in the next video. Hello, welcome in the next video. And the next unit also. In this unit, we will talk about what is liquidity and how can we actually use liquidity. Okay, let's see the definition first. If smart money or banks want to buy a currency pair, they will need sellers in the market. The existing facility to place these positions in the market is called the liquidity. The liquidity is defined by stop losses. Where the stop losses exist is where the liquidity also exists. Smart money needs to activate the stop losses of the existing orders in the market so that they can place their positions in the market. Okay, let's see some examples for this. Okay, so our first type of liquidity are the equal highs and the equal lows. The names speak for themselves. Price will form equal lows when the low points are on the same level. And also price will form equal highs when the highs are on the same level. We have two types of equal lows and two types of equal highs. Okay, let's see an example for the equal lows. On the first example, price is moving in an uptrend, creating series of higher highs and higher lows. After the high has been created, the first high has been created, price did a pullback, but didn't tap into a demand zone. Instead of tapping into a demand zone, it created a low. And after the low has been created, it couldn't break above the last high, and it created another pullback. After this pullback has been created, the price couldn't break below the pullback phase low, so this low point. And instead of breaking below this low point and tapping into a demand zone, it created the second bottom. So this means we have a liquidity line here, which is perfectly equally lined up. And after this, price created a new high. What can we do in this scenario? Price has a great chance to come back to this demand zone and mitigate the demand zone, which has liquidity above, and sweep all of the liquidity from this region, because you have to think with the retail trader's brain. So the retail traders usually open on the double bottoms and the triple bottoms. So if they say a double bottom, they will open a buy position here. So the purpose of the smart money is to sweep all of the retail traders' stop losses, and you want to enter after the stop losses have been swept. So retail traders open a position here. They will place their stop losses on this line, but you have a demand zone right here, and you know that a lot of retail traders open the position on this line, and they have stop losses here. So you will wait for this zone to be tapped. And after the sweep of the liquidity and the zone tap happened, you can easily hop into a position and enter in a long trade, because the market collected the retail trader stop losses. So there's no more stop losses needs to be collected. So after the purge or the liquidity sweep, you can easily hop in a trade. Okay, the same scenario happens with the triple bottoms. The difference is only that price creates triple bottoms, of course. So created the first, second, and third bottom. After it created a new high, but you have the same concept. Retail traders opened on this line. So a lot of positions opened on this line. A lot of stop losses were placed in here, trillions and trillions of dollars and sitting on this line. So market will need to sweep all of those trillions and trillions of dollars and stop losses in order to continue the overall trend, which is bullish in this case. So after the liquidity sweep, price will tap into this zone. And after the sweep and the tap, you can easily hop in a trade. The same scenario happens with the equal highs, the double taps and the triple taps. The only difference is that it's formed on the upside and not on the downside. So price created a downside movement, pullback, created the first tap, little pullback again, created the second tap, equally lined up taps. After this, price will create a new structural high. After this, price will come back and tap into a supply zone, sweep all of the retail traders stop losses. Retail traders sell here, as you know, And yeah, that's basically all. You have a triple tops also, which is the same as the triple bottoms, just on the other side, on the seller side. Market will sweep all of the liquidity from this region too, tap into this supply zone, and after you can hop in a trade easily. Because the main purpose of the smart money is to always enter after the retail trader stop losses have been swept and taken out. So you only want to enter after the stop losses have been swept. This is a really, really, really strong confirmation in smart money concepts and supply and demand trading. Okay, let's hop into the next scenario. Okay, that's your second type of liquidity, which is the trend line liquidity. We have the same scenario, price is moving in an uptrend, creating series of higher highs and higher lows. Price mitigated this demand zone here. After this created an inefficient push to the upside, let's say swept the liquidity from this region because we had a double taps here. So it swept the liquidity and broke structure to the upside with this movement. So it has all the three criteria. So this is a really valuable demand zone. Price arrived in this phase, did a pullback. And after the pullback, price started to form small, efficient movements to the upside, small little break of structures, zero liquidity sweep. So the only criteria here is the break of structures, but those movements are really, really slow and choppy, and we do not like them. So if price turns into this phase, we will call this a liquidity trend line because price is breaking structures to the upside slowly, creating some new highs, new lows, new highs, new lows. And these new highs and new lows will form a trend line because retail traders call this a trend line, and they will open their positions on the trend line touches. So every time price touches this trend line, they will open a buy position here. So let's say they open the buy position here, they place their stop loss here, open the buy position here, stop loss here, opened here, stop loss here. So we have a lot of stop losses just above each other on this line. So we have really, really loads of stop losses sitting just below this line placed by the retail traders. So if you see something like this, and we have a really valid demand zone below the stop losses, so below this line, for example, this one, because it had all the three criteria, we will wait for this zone to be tapped and wait for the liquidity purge and the liquidity sweep. So price has a really, really great chance to sweep all of the liquidity from the retail traders, collect the liquidity, tap into this valuable zone. And after it tapped into this zone and swept the liquidity, you can easily hop in a long trade here after the liquidity has been collected. Because as I said, the main purpose of the smart money is to enter only after the liquidity has been swept on the retail side. So you only want to enter if you know that the liquidity has been collected. If price sweeps this liquidity trend line, you can easily hop in a trade here and enter on the long side of the market. So once again, on the sell side, price created this valuable supply zone because let's say it swept liquidity from this region, swept double bottoms. It created inefficient move, broke structure, so it has all the three criteria, and it started to form small break of structures to the downside over and over and over and over again. If we see something like this, it's the same like on the buy side, because price creates a small break of structures to the downside. So retail traders enter on the trend line touches, so place their stop losses just above the entered positions. So we have loads of liquidity sitting on this line again. We will want to wait for the sweep of this liquidity and tap of this valuable zone, because just think about it logically. We have liquidity, it has to be swept. We have inefficiency, it has to be filled. We have order block or supply zone, it has to be tapped. So this is a really strong confirmation because we basically can predict the direction of the market. We can predict that price will tap into this zone, sweep the liquidity, fill up the inefficiency, and collect the orders from the zone. So yeah, after the liquidity have been swept, you can wait for a tap of this zone and you can enter in a sell position after all of these stop losses have been swept. So yeah, let's hop into the next one. Okay, before we see some live examples, I want to show you something. So price is moving in an uptrend in this scenario. creating series of higher highs and higher lows, breaking structures, creating inefficient movements, and respecting demand zones. So after the last demand zone, so this one has been respected, price created a huge inefficient movement to the upside, broke structure, let's say swept some liquidity from this region, and created this really valuable demand zone because it has all the three criterias. Okay, sorry, let me just adjust this, and let's say it swept the equal tops here. So it has all the three criterias. Okay, after this, price started a pullback phase and failed to tap into this zone. And instead of tapping into this zone, it created double bottoms here. So this means we have equal lows, liquidity just above the zone. So we have one more confirmation because it had all the three criteria. So inefficiency, liquidity sweep, breakout structure, and liquidity creation. So basically it has four criteria. But let's see what happens. Price created another demand zone here because it had inefficient push to the upside, breakout structure, but it didn't sweep any liquidity. And this zone has liquidity just below it. So this zone is literally liquidity. You don't want to trade like a retail traders. If you see double bottoms here and the zone just above the double bottoms, you can't open a position on that specific zone, so this zone. So let's say price is coming down. You're happy, it tapped into this zone. You're happy, you are in profit, everything is going well. But as you can see, it created the third bottom right here. So this means you will be part of the liquidity. You want to spot the liquidity before you become the liquidity. So yeah, price tapped into this zone, you're in profit, your trade is running well. But after this, the liquidity sweep will happen. You will become part of the liquidity, and the tap of this valuable zone will happen because, as I said earlier, you want to enter after the stop losses of the retail traders has been swept. Here in this demand zone, no stop losses have been swept. So you always want to aim for that zone which has liquidity above or below. So yeah, this is a really, really important rule. You always want to spot the liquidity before you become the liquidity. Just remember this and write it down. You know what? I will write it down here and you can screenshot it. This is the golden rule for the liquidity. Spot the liquidity before you become the liquidity. So see you in the next one. Okay, another scenario. Let's say price is moving in an uptrend, creating series of higher highs and higher lows. And we have this valuable demand zone here. It swept liquidity, broke structure, created inefficient movement, just like in the last scenario. Created triple bottoms just below the zone. I mean, just above the zone, sorry. But after this, price didn't come back to mitigate the zone. Instead of mitigating the zone, it started to form series of higher highs and higher lows and continue the overall trend. Let's see what can we do in this scenario. Okay, let's say price was in an uptrend, in a huge uptrend, so it's creating highs, lows, lows. So this is the 4-hour structure. This line is the 4-hour structure, 4-hour structure, 4-hour structure, and these lines are the 50-minute structure, let's say, or for the clarity, let's say this is the 50-minute structure and this is the 1-minute structure. Okay, I will just mark it here. This is the 50-minute and this is the 1-minute. Okay, so on the 1-minute, let's say price moved like this in this region, creating series of higher highs and higher lows, reached its high point, and after the high point, it created a change of character to the downside and started to form lows, a series of lower lows and lower highs until it reached some demand point here, and that demand point reversed the price and started to form a new high. Okay, but we will have supply zones over and over again, and let's say this supply zone up here is unmitigated, and price steps into this supply zone. So sorry, I will just adjust this. So yeah, I will just remove this line for you to see better. Okay, you know that this is the 15-minute structure and these lines are the 1-minute structure. So we have this supply zone up here, But we have this demand zone down here, and we know that the trend is bullish because it's creating series of higher highs and higher lows on the 15-minute. So the trend is bullish. Price tapped into this supply zone. And after the tap of this supply zone, it reversed. Let's say it reversed, started to form lows and highs. We can expect the sweep of this liquidity on the downside movement, so the reversal. So after price reverse on the supply zone, it can sweep the liquidity from this region and tap into this valuable demand zone because it has all the 3 or 4 criteria, because it's swept liquidity, created liquidity, breakout structure, and inefficient movement. So price has a really great chance to mitigate this demand zone and sweep the liquidity from this region. After the tap of this demand zone, you can wait for a confirmation entry. We will talk about confirmation entries in the next unit. So you can wait for a confirmation entry here. And after this, you can hop in a trade, and you have a really great chance for price to create a new high and continue the overall trend, which is bullish in this case, as I said, because it's creating highs, lows on the 15-minute. So yeah, this is how can we use actually the liquidity for your advantage. Okay, let's see the last scenario. Price is moving in an uptrend here again, creating series of higher highs and higher lows, as you can see. I will just explain this on the drawn lines. So let's say price created a demand zone here. After the demand zone has been created, price created liquidity for that demand zone. But price actually broke structures to the upside and formed liquidity also. So we have a triple bottoms here and 3 breakout structures to the upside. How can we identify if it's just a liquidity sweep or a change of character? So if price breaks this low point, that could be easily a change of character because this low has been created a new high here. And if this low point breaks, that can be a change of character here and the change in the trend. Okay, but how can we identify if it's really a change of character or just a liquidity sweep? So let's say we have this demand zone right here. Let me just change color. Okay, let's say we have this demand zone right here and this liquidity line. Okay, sorry. So this liquidity line. Price has a really, really great chance to sweep this liquidity. As I said, we always want to wait for a liquidity sweep this liquidity, tap into this demand zone. And after a tap of this demand zone, it can reverse the price again and create a new high. As you can see on the live chart, I brought an example for this. Price created a low, the first bottom of the liquidity. After it created a breakout structure to the upside, after it created another bottom, breakout structure to the upside. And after this, it swept the liquidity from this region and tapped into some demand zone on the 15-minute here. So yeah, this isn't a change of character to the downside. It is just a liquidity sweep because liquidity sweeps will happen with huge wicks. That's the difference between the liquidity sweeps and the change of character. If you see a liquidity sweep, it will happen with a huge wick. So here's a candle and the wick will look like this, or this on the upside. So yeah. Okay, as you can see, price started to form a series of higher highs and higher lows, created liquidity here again, and with a huge wick, it swept the liquidity from that region too. So yeah, if you're on the 4-hour chart, you will want to see the 4-hour candle to create a huge wick. If you're a 15-minute chart, you want to see a 15-minute candle to create a huge wick and the liquidity sweep. If you are in the 5-minute and the 1-minute chart, you want to see a 5-minute or a 1-minute candle to create the liquidity sweep. But we will talk about this later more precisely. So hello guys, let's see some examples for the liquidity sweeps. As you can see, price was moving in a downtrend here, creating series of higher highs and lower lows and lower highs. So here's our high point, here's a low point, high, lower low, lower high, lower low. And this supply zone caused the last breakout structure. This supply zone broke the last low point here with inefficient movement. And after the inefficient movement and the breakout structure, it came for a pullback, but couldn't tap into this supply zone. So can you just remember the example that I drew for you? That was a long example, but I will just draw the short example. So just bear with me. So this was the example. Price created a breakout structure here with inefficient movement and came for a pullback, but couldn't tap into the zone. Instead of tapping into the zone, it created liquidity here. Okay, after this price broke structure to the downside again. And you could mark another supply zone here. But as I said in the explanation video, you can't open a trade on this supply zone because you have a really great chance to become part of the liquidity, because this part of the this zone will be part of the liquidity, because that could be the third top or the third bottom. So if you open a trade here, you could be in profit, price could do a pullback, but after this, price will sweep all of this liquidity line and tap into the original supply zone that created a liquidity. So this is the perfect textbook example for this, because as you can see, price created a breakout structure here. After it came for a pullback, created liquidity, just like on the example. It created a breakout structure to the downside again. You can't open a trade because you will be part of the liquidity. So let's see what happens after. And we just play price forward. As you can see, price created another tap here. So all of these taps are just part of the liquidity of this supply zone that created the original breakout structure to the downside. Okay, so price has a real great chance to sweep all of these taps and tap into this supply zone. And after the tap of this supply zone, it can reverse the price and create a new low again. Let's see. It actually created a breakout structure to the downside again and created another tap, as you can see. So more liquidity are sitting on this line. So here's another breakout structure. You also can't open a trade here because you want to wait for this supply to be tapped, because you don't want to be part of the liquidity. Okay, let's just play price. After this, as you can see, price swept all of the liquidity from this region. And if you open the trade here on this region after the inefficient push and the breakout structure, it has 3 criteria, of course, but you have to spot the liquidity. If it's part of the liquidity, you can't open a trade on this region, because as I said, you are happy, you are in profit. Yes, you open the position, small profit, but after this, bam, you will become part of the liquidity. And after price swept the liquidity and tapped into the zone that caused the original breakout structure and build the liquidity up for this zone, price could easily reverse. As you can see, it could reverse. It did a change of character here, and actually this zone created the change of character after the zone tap. So it's a really important part that price tapped the zone. After a zone tap, it created a change of character to the downside. And let's see what happens. As you can see, price built up more liquidity for this zone. We have this tap, we have this tap, so we have double taps. You can't open a trade here because you will become part of the liquidity. As you can see, we have inefficiency here, we have liquidity here, we have change of character here. Price has to fill up this inefficiency, price has to tap this zone, price has to sweep the liquidity. So you can't open a trade here, you want to wait for this zone to be tapped. Let's see what happens. Price built up more liquidity, as you can see. Here's more liquidity on this line. Built up for this zone, more liquidity, so loads of liquidity, loads of orders, loads of stop loss of the retail traders are sitting just above this line, so the orders and the stop losses are here. What will stop the liquidity hand? This zone. If price taps this zone, it can reverse the price and create a new low. Let's see. As you can see, price swept all of that liquidity, swept all of the stop losses, tapped into this zone, and after it has a great chance to reverse. Started to reverse. So as you can see, we had double liquidity sweeps from this region and from this region. So after double liquidity sweeps or just a single liquidity sweep, price has a really great chance to reverse and continue the bearish order flow. As you can see, that's what I was talking about. Price had to sweep enough liquidity in order to continue the overall order flow, which is bearish in this case. So once again, this zone created the original breakout structure, built up liquidity on this line for this zone. Of course, price created breakout structure here to the downside and inefficient movement, but it didn't build up liquidity here. So this zone is invalid. This zone is part of the liquidity. Price swept all of this liquidity from this region, tapped into a supply zone that caused the original breakout structure and built up the liquidity. After this, it reversed, created the change of character to the downside here. After the change of character and the zone tap, it built up more liquidity in this region. After it after price swept the liquidity from this region again, tapped into the zone that caused the change of character and built up the liquidity. After a zone tap, as you can see, the order flow is continued and a huge movement to the downside came into the market. So this is how you can use liquidity to your advantage. That's why I said the liquidity is the +1 criteria, because it's a really, really strong confirmation. So here, only true criteria happened: breakout structure and inefficient move, but price didn't build up liquidity, and this zone built up liquidity. So this zone is more powerful than this zone. So you will wait for the tap of this zone and the liquidity sweep. Okay, let's see the next example. So let's see another example. As you can see, price created inefficient push to the upside from this demand zone. It broke structure, and after the pullback, price couldn't tap into this zone, and instead of tapping into this zone, it built up liquidity here, also here. So all of this region is liquidity for this zone. So just imagine how many retail traders opened positions on this line, on the trend line, or I don't know how they call it, the resistance or support, I don't know. So just imagine how many retail traders open positions here. So all of the stop losses are located below this line. So the stop loss is located somewhere here, and this zone could hold the liquidity sweep. After this, price started to form series of higher highs and higher lows, but with slow movements, as you can see, choppy, wiki behavior, slow movements, small breakout structures, small inefficiencies, or even no inefficiency. So this means this is a liquidity trend line. As you can see, we have a trend line here, and price kept touching this trend line over and over again. So retail traders open their positions on the touches of this trend line, even here. So all of their stop losses are located just below this line. So this is a liquidity trend line. We have liquidity here. So sorry, we have liquidity here, we have liquidity here. So price has a really, really great chance to sweep all of this liquidity, all of this void, and tap into this demand zone, because liquidity was built up just for this zone. As you can see, this is the next zone, I mean the last zone before the liquidity build up. So price built up liquidity for this zone, and price is a really, really great chance to sweep all of this liquidity, tap into this zone, and reverse the price to the upside to continue the overall bullish order flow. So as you can see, this is what happened. Price tapped into this zone. After a tap, it immediately reversed and started to form a series of higher highs and higher lows again to continue the overall bullish order flow. So yeah, liquidity is a really, really powerful tool. You really want to master it, because you want to spot the liquidity before you became part of the liquidity. This is a really important golden rule in trading and in liquidity concepts. Always spot the liquidity, always. See you in the next one, guys. Okay, so let's just talk about the liquidity sweep or the change of character. I talked about this in the earlier video, but I just want to clarify things more precisely. So let's say price is building up an uptrend, creating series of higher highs, higher lows, highs, lows. But price actually created a liquidity line here, which is a triple bottoms. So I will just mark it as a triple bottoms here. Okay, so as you can see, this low point has created the last high. So if this low point breaks, you can call it a change of character. But how can we identify if it's a change of character or just a liquidity sweep? Let's say we are on the 4-hour time frame. So I will just write a 4-hour here. So we are on the 4-hour time frame. If we see a candle like this here, it can also be a red candle, solid downside candle. It doesn't matter, a color doesn't matter. So if we see a candle like this with huge wick, and a huge wick taps into a demand zone, or it doesn't have to tap into a demand zone, it just has to sweep the liquidity. So if a huge wick sweeps the liquidity, then you can easily know that it's just a liquidity sweep and not a change of character. Because if price does not create something like this and it just bodies below this line, then it will be a change of character and it will stay below this zone. But if it wicks below the liquidity line and it immediately comes back up on the 4-hour time frame, then you know that it's just a liquidity sweep and not a change of character. But the same concept goes on the 15-minute time frame. So if this is a 15-minute structure, then you will want to see a 15-minute candle and wick does something like this. So you are on the 15-minute, I will just write it to the 15-minute. And on the 15-minute, you want to see a 15-minute candle do something like this. If you are on the 5-minute, you want to see a 5-minute candle do something like this. If you are on the 1-minute, you want to see a 1-minute candle do something like this. Because let's say you are on the 4-hour. No, let's say you're on the 15-minute, say with the 15-minute. So this is the 15-minute chart. And the 15-minute candle does something like this. If you switch to the 1-minute, you will have 15 candles on the 1-minute. That just equals to this 15-minute candle. So you have a chance that those 15-minute, 1-minute candles will just stay below and close below this line. So you won't really see that it's a liquidity sweep or not. Because it's the 15-minute liquidity, you want to see a 15-minute candle to sweep all of that liquidity. So yeah, I hope it makes sense. Let's move on. Okay, let's see a live example. So as you can see, we have this demand zone right here. It created inefficiency to the upside and changed character here, started the whole bullish order flow. Okay, it's not about the demand zone right now. It will be about the liquidity. So as you can see, we have bottoms here, 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 here. And these are almost perfectly lined up, creating equal lows. So equal lows above the demand zone means if these lows will be swept, this demand zone can hold the price and reverse the price to the upside. So just think logically again. We have these lows. Retail traders open their positions on this line, so their stop losses will be located just below it. So just below their stop losses, we have this demand zone. If price sweeps the lows, sweeps the liquidity, this demand zone will hold the sweep, and it can easily reverse the price, as I said. So as you can see, price tapped into this demand zone with a liquidity sweep because we are on the 15-minute chart currently, as you can see. And this is a 15-minute candle right here, this one. And it looks like this small body, really small body with a huge wick to the downside. So this means this was only a liquidity sweep. And after this, price can easily reverse and continue the bullish order flow. So let's just test it. I will show you. So as you can see, after a liquidity sweep, it just blew to the upside. This means the market collected all of the stop losses and they could place more buy orders because the liquidity, the stop losses have been swept. They could place more buy orders on this zone because it reverses the price and it can continue the overall order flow, which is bullish. Okay, but let's see these sweeps. I will just play price, not play price, sorry. Stop it. So we just forward price here. Okay. So on the 50-minute, this candle just looks like a liquidity sweep. Let's see, it opened at exactly at 9, and the next candle opened at 9:15. So on this movement, we will have 15 1-minute candles, and those 1-minute candles will look like a break of structure and the continuation of the bearish order flow, because in this region we have a bearish order flow, as you can see, series of lower highs and lower lows. Okay, price broke through this last structural point, we can say that. So we can expect supply trade here if we are on the 1-minute chart. But we know that it was just a liquidity sweep and not a break of structure. And after a liquidity sweep, we will expect the order flow to be continued. So if I switch to the 1-minute chart, you will see that this is 9 a.m. The 50-minute candle opened here, and this is 9:15, it closed here. So on the 1-minute, as you can see, we have 15 candles, and those 15 candles just broke the structure and started a pullback. So if we only trade the 1-minute chart, that's the importance of trading correlated timeframes. So if you're only trading the 1-minute chart, we will think that is a break of structure to the downside, and we will open a supply trade here because it created inefficient movement and the break of structure here. But we trade multiple timeframes, so we will know that this was just a liquidity sweep on the 15-minute, and it won't confuse us on the 1-minute because we know that the liquidity has been swept, and we will look for long entries inside of this demand zone. So as you can see, it was just a sweep on the 15-minute, and after the sweep and the liquidity collection and the demand tap, price started to continue the overall bullish order flow to the upside. So that's the importance of knowing if it's just a liquidity sweep or a change of character or a break of structure. So welcome in the next unit and also in the next video. We finally reached the entry unit. In this unit, we will talk about the entry types, such as change of characters, flips, and continuations. Okay, first let's talk about the change of character. What is a change of character? When the market structure changes to bullish from bearish, or changes to bearish from bullish. So basically, it's the change in the overall trend. So as you can see on the first example here, we can see a bullish structure because price is creating a series of higher highs and higher lows, breaking structures to the upside, creating demand zones over and over again, breaking through weak highs, breaking through supply zones. So it's a bullish structure. This bullish structure can change into bearish structure if price, on the second example, if price breaks through the last demand zone or breaks through several demand zones. We'll talk about the entry criteria later. So as you can see, price broke through the last demand zone, which was here, because this demand zone created an efficient push to the upside, broke structure. So price broke through this demand zone and this demand zone also. So this means we have a double change of character here, the first one, and here the second one. After this, we can write the expectation order flow. And as I always say, if a zone breaks, then an opposite side zone will be automatically created. So price broke through several demand zones, so supply zone has been formed, which is here. Let's say it's here. After this, we can write the expectation order flow, and if price reacts on this supply zone, we can happy on trade. After this, we can expect the break of structure to the downside over and over again, which you can see on this example. So as you can see, price was in an uptrend here, price changed character here, because it broke through the last opposite zone, which was a demand zone. So if price breaks through a zone, an opposite side zone will be created. So it created a supply zone up here. Let's say price reacted on this. After the reaction on this supply zone, price broke structure to the downside here. It also broke the weak low. So it created a strong high. This is our strong high. After this, price did a pullback again here, reacted on another supply zone. I will just mark it, sorry. So reacted on another supply zone. After it broke structure to the downside again. So as you can see, the overall bullish structure changed character, changed into bearish structure. So change of character is basically changing the overall trend from bullish to bearish or from bearish to bullish. Let's say price changes character to the upside again. And I will just mark this was the last supply zone because this supply zone created an efficient push to the downside, broke structure to the downside. Let's say swap some liquidity from this region. So we have this supply zone right here. Price breaks through this supply zone, which means it will change character to the upside. And it does not tap into any unmitigated zone because as you can see, this supply zone was already mitigated by this movement. So it does not tap into any unmitigated supply zone. So this means a demand zone will be created because price broke through a zone, then an opposite side zone will be automatically formed. This is a golden rule. You just have to memorize this. So price created a demand zone because it broke through a supply zone. And after this, let's say this is a 1 minute chart. You can enter on this demand zone in a trade and you can write the expectational order flow. So price has a great chance to come back down to this demand zone, react on this demand zone. After the reaction on this demand zone, you can hop in a trade. This is the power of change of characters. But let's talk about the change of character criteria and how to actually use them to our advantage. Okay, let's see a concrete example and the criteria. So as you can see on this first example, first image, price is moving in a downtrend. So this is the 15-minute chart, and this will be the 1 minute chart. So as you can see, price is moving in a downtrend, creating a series of lower lows, lower highs, respecting supply zones, breaking through demand zones, and breaking structures through downside. So this is the overall 15-minute structure. And as you can see, this supply zone has been created because it broke structure to the downside with inefficient movement. And on the way up, it created liquidity for this zone, as we talked about in the liquidity units. So it created perfect liquidity for this zone. Price swept this liquidity. After the liquidity sweep, it tapped into this supply zone. It's on the 15-minute chart. So as you can see, this leg will look like this on the 1 minute chart. This pullback will look like this on the 1 minute chart. And this upside leg will look like this on the 1 minute chart. So price tapped into or almost tapped into this supply zone. It's on the way up to mitigate this supply zone. It's swept the liquidity also. So let's focus on the 1 minute chart. As you can see, after the liquidity sweep, price created series of higher highs and higher lows, but the overall structure is bearish, as you know, because the 15-minute structure here, we can easily read that it's bearish. So we won't hop in a long trade here because we will know that price will react on this supply zone. And after the reaction, we can enter in a short trade and ride the expectation order flow, which is bearish. Okay, so let's see the criteria. The first criteria for the change of character is the higher time frame mitigation. So as you can see, I will just write it here. This supply zone is the 15-minute supply zone. So on the 1 minute chart, a 15-minute supply zone will be a higher time frame mitigation. So if price steps into this supply zone, the first criteria will be fit. Okay, let's see the second criteria. Liquidity sweep. It's an optional extra confirmation. So what do I mean under liquidity sweep? As you can see, price created a series of higher highs and higher lows here in this region, and just below the supply zone, price created double tops and also triple bottoms. So just under the supply zone, 50-minute supply zone, we have liquidity. If price sweeps the double tops, we will have a liquidity sweep, a strong confirmation, and after the liquidity sweep and the double top sweep and the higher time frame mitigation, price can reverse, sweep the downside liquidity. So these triple bottoms, it can sweep the downside liquidity. This is the 1 minute chart. And after this, price can create a supply zone because we had this demand zone right here. This was the last demand zone because this demand zone created inefficient push to the upside. It swept liquidity and it also broke structure to the upside here because this was the last high. So this demand zone has all the three criteria. And this supply zone, I will just mark it with a box. So this supply zone broke through this demand zone. And as I always say, if a zone breaks, an opposite side zone will be automatically created. So price broke through this demand zone, a supply zone was formed here. And after this, you can hop in a trade, you can set an order on this supply zone because a change of character happened after a higher time frame mitigation and the liquidity sweep, double liquidity sweep, or also triple liquidity sweep. So this is a really strong confirmation for the short entries. So yeah, price broke through this demand zone, created a supply zone. You can easily set an order on this supply zone. And the third criteria, it's also an extra confirmation, the double zone break. If price breaks through double demand or supply zone. So as you can see, we have this demand zone here also. So this is the first demand zone up here. This is the second demand zone down here. If price breaks through this demand zone also, that will be a really strong and great confirmation for the short entries. And let's see, price only created this supply zone. It broke through these two demand zones with an inefficient huge push to the downside, and it created this supply zone. You can also enter on this supply zone because price will have a great chance to come back after this supply zone and fill up the inefficiency, fill up the orders, collect the orders, tap the order block and the supply zone. So yeah, this is a really strong confirmation. So once again, the three criteria. The first one is unnecessary. I mean, it's necessary. The higher time frame mitigation, it has to happen. Without a higher time frame mitigation, it won't be a change of character. It will be just a liquidity sweep or anything like that. So it has to mitigate a higher time frame zone. The second one is a liquidity sweep. It's an optional extra confirmation. So it's a really good confirmation, and it almost has to happen. And the third one is the double zone break, and it's also an extra confirmation because that will be, you will be more sure about your trade and your position if it breaks through several zones, 2 or 3 zones. Okay, let's see an example for the double zone break. So the scenario is the same. Price broke through the last demand zone, which is this one, created this supply zone. After this, price started to do a pullback here, but it couldn't mitigate the upper zone. Instead of mitigating the upper zone, it created liquidity. And after the liquidity creation, it broke through the next demand zone, which is this one. It broke through this demand zone with this movement. So a zone has been broken. So this means an opposite sign zone will be created, which is this supply zone. Okay, so the first zone, the upper zone, is the extreme zone. We call it as an extreme zone. The downer zone, this one is the decisional zone. So I will just write it here. This is the extreme, and the downer is the decisional. Okay. So as we talked about the liquidity unit, price built up double taps liquidity for the extreme zone, as you can see. So you can't really open a position on the decisional zone because it has a great chance to sweep the liquidity and you will be part of the liquidity. So you can't really put an order limit on this zone because you will be swept and the extreme zone will be mitigated. And after the extreme zone mitigation, you can set an order on this zone and you can hop in a trade. So yeah, it is a really, really important part that you don't want to become part of the liquidity. You always wait for the liquidity sweep. So you see double taps here. A lot of early sellers will enter on the decisional zone. So loads of orders will be placed on this zone, and price will sweep the orders, sweep the stop losses, and mitigate the upper extreme zone. Okay, this is the first scenario. The second scenario is that price doesn't create liquidity. It just does a pullback. It doesn't create liquidity, but breaks through another demand zone. Let's say it breaks through +1 demand zone, so this downer area too. So it has double zone break also. In this case, you can safely use the decisional zone because the extreme zone has no liquidity. As you can see, decisional zone is safe to use because no liquidity has been created below the extreme zone. And we have one more confirmation for this decisional zone use. If price creates a pullback, it creates liquidity, then you can easily and safely use the decisional zone because price built up liquidity for the decisional zone. And more likely, this decisional zone will hold the price after the liquidity sweep. So if price sweeps the double taps from this region, this decisional zone can easily hold the price, and it doesn't really have to mitigate the extreme zone because liquidity have been swept. This is the next zone after the mitigation, after the liquidity sweep. So you can easily set an order limit on this decisional zone, and you don't have to wait for the extreme mitigation. Okay, let's see a complete example. So we have a criteria for the zones here. If you see a 4-hour zone, you will have to wait for a 15-minute change of character inside of the 4-hour zone. So as you can see, we have this 4-hour structure here, breaking structures to the downside, creating series of lower lows and lower highs, and creating supply zones. Price created this 4-hour supply zone, and price just tapped into this zone. This will look like this on the 15-minute chart. So this leg and this leg will look like this on the 15-minute. Okay, price reached the 4-hour supply zone here, tapped into this 4-hour supply zone, and you will have to wait for a 15-minute change of character. So as you can see, this was the last demand zone that created a new high with inefficient push and breakout structure, and this demand zone caused the tap of the supply zone, the 4-hour supply zone. You will have to wait for a 15-minute change of character here. So this is the 15-minute chart. Price changed character on the 15-minute and broke through the last demand zone, which means a supply zone will be formed, and it was formed here. Okay, so this movement, this downside and upside movement will look like this on the 1-minute chart. So after price mitigated the higher time frame 4-hour supply zone and broke structure or changed character to the downside and broke the demand zone, it created a 15-minute supply zone, which is this one and this one. And on the 1-minute chart, you will have to wait for a 1-minute change of character inside of that 15-minute supply zone. So price is moving in a downtrend here, which is this leg of the 15-minute chart, and after it creates a pullback moving in an uptrend here, which is this leg of the 15-minute chart, and it almost reaches the 15-minute supply zone. This is the 15-minute supply zone, almost reaches it, creates double top, sweeps the liquidity to the upside, taps into a higher time frame zone, which is a 15-minute zone. So two criteria are fit: higher time frame mitigation, liquidity sweep, and after this, price breaks the last demand zone, which was the last demand zone that caused the tap of the 15-minute supply zone and the breakout structure and the inefficient move. So price breaks through this zone. This means a supply zone, a 1 minute supply zone will be formed here. And you can safely use this 1 minute zone to enter in a position. And this will be your entry point. So once more, if you see a 4-hour zone, you will have to wait for a 15-minute change of character inside of that zone. If you see a 15-minute zone, you will have to wait for a 1 minute change of character inside of that zone. This is a golden rule. Okay, let's see a live example for a change of character. As you can see in this region, price is moving in a left trend, creating highs, lows, highs, potential lows, potential highs. So the expectational order flow is bullish. This is the 15-minute chart. So as you can see, this was our last structural high point. This was the last structural low point. Let's find the demand zone that broke through the last structural high point. That's fat liquidity and created inefficiency. As you can see, we have inefficiency in this region, huge inefficiency. And actually, we can mark this candle out as our demand zone because the break of structure and the inefficient move came into the market from this candle. So it broke structure here. Why cannot be replayed? What just happened? Sorry for this mistake. So yeah, the break of structure happened here. Inefficient push came into the market here. And this demand zone actually swept liquidity from this region. As you can see, we have double taps here. So this will be our really valid demand zone. We are expecting the tap of this zone. And after the tap of this zone, we will wait for a 1 minute change of character inside of this 15-minute POI, this 15-minute demand zone. And after the 15-minute zone tap and the 1 minute change of character, we can hop in a trade and ride the expectation order flow, which is bullish. Okay, so as you can see on the 15-minute chart, this looks like just a one big leg, and this will look like just a one big leg to the downside. But on the 1 minute chart, it will look like structure to the upside and structure to the downside. Let me just switch to the 1 minute chart. So as you can see, this is really just a structure, bullish structure, creating series of higher highs and higher lows. And the downside structure is bearish, creating series of lower lows and lower highs. Actually, we have a liquidity just above this zone here. So this is one more extra confirmation, and we have this liquidity trend line also. So this zone will be really valid. We can expect the tap of this zone, and after the tap of this 15-minute zone, we can wait for a 1 minute change of character, and after a 1 minute change of character, we can hop in a trade. Okay, let's see what happens. Let's just play price forward. As you can see, it coming down nicely, almost taps the zone. And the tap of the zone happened, as you can see. And actually, this was the last supply zone here that caused the tap of the demand zone, because as you can see, it created huge inefficient push to the downside, and this supply zone broke structure here. And also it swept some liquidity from this region. As you can see, we have double or equal bottoms here. So this is our last supply zone. If price breaks through this supply zone, that will be our change of character. And if this supply zone breaks, the demand zone will be formed, and we can hop in a trade on that demand zone that was formed by the break of this supply zone. Okay, but right now, demand is in control. If price taps this supply zone, supply will be in control. That's why we have to wait for a change of character to let demand be fully in control. Okay, let's see what happens. As you can see, price tapped this supply zone and reacted on it. So supply took over control from demand again. So supply is in control again. Let's see what happens. Let me just play price forward. Okay. As you can see, price broke structure to the downside here and broke structure to the downside here. So I will just mark out the last supply zone, which is this one. If price breaks through this supply zone, then demand will be in control. If price reacts on this supply zone, supply will be in control, and we will have to wait for a change of character again. So two scenarios here. If price breaks through the supply zone, demand will be in control, and we can hop in a trade on the demand formed by the break of this supply zone. Or the second scenario, if price reacts on the supply zone and reaches deeper areas, we have to wait for a fresh new supply zone break, and after a change of character, we can hop in a trade. But the first criteria is fit because price tapped the higher time frame demand zone. Second criteria is fit because it's fat liquidity. And the third criteria is not fit because we did not break through double zones. But let's just see what happens. As you can see, price reacted on the supply zone, so supply is in control. Supply is in control. Okay, and demand took over control from supply because it broke through the supply zone, as you can see. So we can mark out the demand zone, which is this one here. because as I said, if a zone breaks, an opposite side zone will be automatically formed. So as you can see, this demand zone created huge inefficient push to the upside, change character here, swept liquidity from this region because we have this double top here. So it has all the three criteria: swept liquidity, zone break, higher time frame mitigation, liquidity sweep on the other side. The only missing thing is that it only broke through one supply zone, but it isn't a problem because it happened with huge inefficient push. So in this case, we can easily set an order limit on this zone, and we will use 12-point pip stop loss. We will talk about the lot sizes and the stop losses in the money management unit. So we did set an order limit on this zone, as you can see, and our target point will be the next unmitigated 15-minute zone, which is this one here. As you can see, this is the next unmitigated 15-minute supply zone. So we can easily target this zone because, as you can see, it changed character to the downside here with inefficient movement. So this was the supply that changed character on the 15-minute chart. So this is a really, really valuable supply zone. So the target point will be this supply zone. Okay. For this trade, let me just adjust this. So for this trade, we have 1:9 risk-reward ratio. We risk 1% of our capital, but we will gain 9% profit. Okay, so let's see what happens. The position is all set. If price reaches this entry point, we will be tagged in the trade. So let's see. As you can see, price tapped this zone. We are tagged in the trade now. Let's see how it goes. Okay, strong reaction, really, really strong reaction. We are in profit, huge profit. As you can see, it also broke through the last supply zone, this huge supply zone that caused the tap of the 15-minute demand zone and break of structure and huge liquidity sweep. So this is an extra confirmation because price broke through this supply zone, this valuable supply zone. We have a confirmation that the expectation order flow, which is bullish, will be continued. So we can easily target this supply zone, the upper 15-minute supply zone. Let's see what happens. And our trade is done. TP hit for 1:9 risk reward. So we just booked 9% of profit. This is the power of change of characters and waiting for a right zone to be tapped and the change of character inside of that zone. So once more, this zone has been created. Price reached this zone, switch to 1-minute chart, wait for the last 1-minute supply to be broken. Last 1-minute supply broken. Demand zone has formed. Limit on that demand zone, hop in a trade, TP hit. This is really simple, based on liquidity concept, supply and demand concept, who's in control concepts, and is the combining all of the concepts together, it will be really, really, really strong, as you can see. Welcome to the next video. This video will be about the flips. So as you can see, I wrote this text right here that says every flip is a change of character, but not every change of character is a flip. What do I actually mean under this? Let's see an example for this. On the first example, price is moving in a downtrend, creating series of lower lows and lower highs, creating supply zones over and over again. So let's say these legs are the 15-minute structure and these legs are the 1-minute structure. So we have this 15-minute supply zone over here. Price started to do a pullback to reach the supply zone. It tapped the supply zone, and after a tap of the supply zone, supply took over control from demand. But we have this demand zone, this 1-minute demand zone right here. Price reacted and rejected on this demand zone, which means demand took over control from supply again. So demand is control on this movement. But after this, price broke through this demand zone and changed character here, which means supply will be in control, because if a zone breaks, an opposite side zone will be created. And if a demand breaks, a supply zone will be created. And we call this scenario a demand to supply flip, D2S. So this is a demand to supply flip. So what did I mean under the average flip is a change of character, but not every change of character is a flip, is that, as you can see, a flip and demand to supply flip also changes character here. It changes character to the downside. But a simple change of character does not flip anything, because a simple change of character, let's say price reacts on this supply zone, it breaks through the last zone, but it doesn't react on that last zone, so it does not flip anything. It just simply changed the character. So once again, every flip is a change of character, but not every change of character is a flip. We have this bullish scenario here. So as you can see, price is moving in a downtrend here. Price tapped into a high time frame demand zone because let's say price is moving on a bullish trend in this region. So yes, price tapped into this demand zone. After the tap, demand took over control from supply, but price tapped into this 1 minute supply zone. So supply took over control from demand again. So on this leg, supply is in control, but price broke through this supply zone with an inefficient push. So this means a demand zone has been created, which means demand is in control and you can use this zone to enter in a trade. And here again, after the break of this zone and the change of character happens and the flip happens, you can use this zone to happen a trade. Extra confirmation here is also the liquidity. If price does something like this, so creates a pullback, creates a liquidity just below the zone, that's an extra confirmation that the liquidity sweep will be stopped by this supply zone, and you can easily set an order limit on this flip zone. So you just set an order limit here, and you can target the next unmitigated 15-minute zone somewhere around in this region. And the same goes on for the bullish scenario. If price breaks through this supply zone creates a demand zone, you can set an order limit on this demand zone. So you can set an order limit here. Extra confirmation is the liquidity here again. If price creates a pullback but can tap the zone, instead of tapping the zone, it creates liquidity. You will know that if price breaks structure to the upside, price will come back to mitigate the extreme demand zone and won't react on this decisional demand zone. So yes, these are the flip scenarios. Let's see some live examples for this. Okay, so let's see live example for the flip scenario. As you can see in this region, price is moving in an uptrend, creating a series of higher highs and higher lows. We have this extreme demand zone, extreme 15-minute demand zone right here that changed character on the 15-minute chart or the 5-minute chart, and it created liquidity just above the zone, as you can see. So this is a strong confirmation for this zone. After this, it just continues to broke structure to the upside until it reaches turning point. And after a turning point, it turned into bearish trend. So this is a bearish scenario here. So what we are waiting for is that price taps this zone and creates a change of character or a flip after the zone tap. Okay, so let's see what happens. As you can see, price tap the zone. I will just play price forward. Price reacted on the supply zone. As you can see, this was the last supply zone. Actually, we can use the wick. So this was the last supply zone before the zone tap happened. Price reacted on the supply zone, so supply is in control again. We have to wait for a flip or a change of character. So if price doesn't break below this low and does break above this supply zone, that will be our flip scenario. Let's see what happens. Actually, it created liquidity, as you can see. We have this liquidity line here, perfect equal bottoms. So we have an extra confirmation. So we are just waiting for these equal lows to be swept. And after the sweep of the equal lows, we can expect the reversal point and the flip or change of character scenario. Okay, let's play price forward. As you can see, the sweep happened with this candle here. This is a perfect sweep candle. This is the last supply zone that caused this sweep and almost a break of structure to the downside. So if this supply zone breaks, or this supply zone breaks, we will have a flip or a change of character scenario. Let's see what happens. As you can see, price reacted on that supply zone, but couldn't break above that zone. So we are reacting on that zone, means supply is in control. As you can see, supply took over control from demand again. So if price breaks through this zone, a demand zone will be formed, and the flip scenario, a supply to demand flip will be formed. So let's see what happens. As you can see, a supply to demand flip happened, and we have this demand zone down here that caused the flip. And also it has liquidity here. So we are waiting for this zone to be tapped. I can actually set an order limit on this demand zone with 2 point pip stop loss. And I will just play price forward. Let's see what happens. Actually, price broke through another supply zone here. So this is an extra confirmation. This is a really, really strong zone that started the whole order flow that broke several supply zones to the upside. And it also created some more liquidity for this zone here, as you can see. So we have double liquidity confirmation. And it also swept the liquidity from this region. So this is a really, really strong zone. Okay, our limit is still here. We can actually target the next higher time frame zone, which could be, let's switch to the 5-minute chart, which could be actually this zone, because this zone is a huge supply zone, as you can see. So I will just mark this supply zone out and set this zone as our target point. Okay. Switch back to the 1-minute chart. We are waiting for this zone to be tabbed. Let's play price forward. Actually, we are tabbed into the trade. As you can see, we are tagged, and price almost hit our stop loss, but it did not reach the stop loss level, so we are still in the trade. We had a huge reaction. Actually, this movement, this candle was just a simple liquidity sweep. As you can see, we have liquidity in this region for equal candles. So as I talked about in the liquidity units, this candle is just a perfect liquidity sweep candle. Sweep the liquidity from this region, and after the liquidity sweep, it can reverse the price and continue the overall bullish order flow. So we are expecting this supply zone to be tabbed, and this trade is actually 1 to 10 risk-reward ratio. So we are risking 1% and we will gain 10% profit. Let's see what happens. Just play price forward. As you can see, price is moving up, ranging a little bit. I will just extend this zone. Play price forward. As you can see, it's creating breakout structures to the upside and immediately hit TP. So it ranged here, created lots of liquidity here also, and lots of liquidity here also. And this candle swept that liquidity. And after the upside movement, swept the liquidity from this region. And after the liquidity sweeps, it just continuously broke structure to the upside, and it did hit our TP, which was the 5-minute supply zone. So as you can see, this was the flip scenario. So once again, price did hit the higher time frame demand zone, which is this one. After the high-end time frame demand zone hit and mitigation, it created liquidity. After price swept that liquidity, so we have a higher time frame zone, first criteria, liquidity sweep, second criteria, liquidity creation, one more criteria, and the flip scenario, because this was the last supply zone that created a breakout structure to the downside. And the price reacted on this zone, couldn't break above, just wicked above. It isn't a break. After it reacted on that, supply took over control from demand again. After this, demand took over control from supply because it blew up to the upside with a huge inefficient movement, breaking through this supply zone. Limit order on this zone. Limit order did set. Liquidity sweep from this region. We are tagged into the trade, targeting the next unmitigated 5-minute or 15-minute supply zone. And bam, TP hit. So this is the live example for the flip scenario. See you in the next one. Hello, welcome to the next video. We will talk about the continuation examples. So let's just begin. As you can see, these black arrows, black lines are the 15-minute structures. So this is the 15-minute structure, and it's bullish, as you can see, creating series of higher highs and higher lows. The last low has been created, and after the demand zone has been formed because it broke structure to the upside here with inefficient movement. Let's say it swept some liquidity from this region. So we have a really valid demand zone right here. Okay, as you can see, the 1-minute structure is the red arrows, red lines. So the pullback started to form on the 1-minute, and it's bearish. We are expecting the tap of this valuable demand zone. And after a tap of this valuable demand zone, we can expect a change of character and the continuation of the whole bullish order flow, right? Okay, let's say you missed this first entry, price swept some liquidity into this demand zone. After a liquidity sweep, it changed character to the upside here and here also, and broke through several supply zones. For example, this supply zone, so many supply zones. Let's say you missed the change of character entry here and you couldn't enter in the position. So you did miss it. What can you do in this case? You couldn't enter here. You will want to wait for a continuation example, a continuation entry. And if price breaks structure to the upside after this downside movement and the first perfect entry, you can look for a scaling trade in the form of a continuation. So let's say price breaks structure to the upside again. As you can see, it broke structure here to the upside. So I will just mark it with BOS long. It also broke this supply zone here and didn't tap into this supply zone. So this means a new demand zone right here will be formed. So you have this demand zone right here. Okay. In this case, I wouldn't set an order limit on this line, on this demand zone, because it could be risky. It could be part of the liquidity. In a continuation entries, I recommend you to wait for a liquidity creation. So if price comes back down after the break of structure and, for example, creates this type of liquidity, double bottoms, and after it breaks structure, it doesn't have to break structure, it doesn't really matter, it just have to create liquidity. So let's say it created liquidity, triple bottoms. After this, you can easily set an order limit on this demand zone, because this is a really, really, really strong confirmation that the zone will hold the price after the liquidity sweep. So as you can see, we have this liquidity right here, triple bottoms, liquidity down. And after you saw this liquidity and the break of structure and the supply zone break, you will have a perfect continuation example. So the criteria is, you miss the first entry, you miss the change of character entry or the flip entry. After, you have to wait for a, I will just write it down here, break of structure slash zone break. So this is the first criteria. The second criteria is the inefficient push. The third criteria is the liquidity. So you miss the entry here. The break of structure happened to the upside. The zone break happened, so double confirmation. It happened with an inefficient movement. Second confirmation, after it created liquidity just above the demand zone that broke structure. Third confirmation, third criteria. So you can easily set an order limit on this order block, on this demand zone. And it has a really, really great chance to mitigate the order block, sweep the liquidity, tap into this order block or demand zone. And after it, you can target the next unmitigated higher time frame supply zone, which is this one in this case. So yeah, this is the first continuation example. Let's see a live example for this one. So that's a live example. As you can see, price is moving in a bullish trend right here, creating series of higher highs and higher lows, building up liquidity. This was the last demand zone that created huge inefficient push to the upside, swept liquidity from this region, broke structure here, and has liquidity trend line just above it. So this is a really valuable demand zone. As you can see, price, after the high point has reached, it reversed and started to do a bearish trend on the 15-minute chart to mitigate this demand zone. After the mitigation of this demand zone, it changed character to the upside with this movement. So this is a 15-minute change of character on this line. And as you can see, this demand zone right here, I will just zoom in, this demand zone right here caused the change of character, the 15-minute change of character here. So this will be our 15-minute demand zone that we are looking for. And we are looking for a entry example, for example, a change of character, a flip, or a continuation inside of this demand zone. Okay, let's switch to the 1 minute. No, sorry, one more thing. So the expectational order flow is bullish, right? Creating series of higher highs and higher lows, mitigating demand zones, changing characters to the upside, mitigating demand zones again. So the expectational order flow is bullish. We are waiting for some scenario like this. Okay, let's switch back to the 1 minute chart and take a closer look. As you can see, price changed character. Price was moving in a downtrend here, and price actually changed character here to the upside and started to form a range. Also liquidity here, swept that liquidity and actually changed character to the downside with this movement. So we can mark a valid supply zone out right here. This is a really valid supply zone, because as you can see, it has inefficient push to the downside, liquidity sweep, and change of character to the downside. Okay, so we are waiting for either a flip scenario or a change of character scenario. And if we can't enter on that flip or change of character scenario, we are waiting for a continuation example. Okay, let's see what happens. Price mitigated the supply zone, as you can see, supply took over control because price couldn't, supply took over control from demand because, as you can see, price reacted on the supply zone and did reverse. So we had a strong rejection. Let's see what happens next. It's in the supply zone again, and the break of the supply zone happened, as you can see. And the break of the supply zone happened from this candle. Okay, let's just extend this and let's see what happens. As you can see, price continuously breaking structure to the upside with small, not so inefficient movements. So you could have just set an order limit on this demand zone on this order block, but this isn't the best case. This isn't the best option. So if you were insecure about it, you just want to skip on this trade and look for a continuation example. So let's see what happens. Price taps this zone, price feels the liquidity from this region with this candle, as you can see, mitigates the whole zone. And after this, it started to break structure to the upside. So you were insecure about this trade. You didn't want to really enter here. So you are looking for a continuation example right now. Okay, as you can see, price broke structure to the upside with inefficient movement with these two inefficient candles here. It also swept some liquidity from this region. So a really valid demand zone has been created right here. This whole candle is about demand zone. Okay, let's see what happens next. So two criteria of the three are fit because we have inefficient push and break of structure to the upside and some liquidity sweep. Right now, we are waiting for a liquidity creation. It really has to create liquidity. And as you can see, it slightly created some liquidity right here. Small liquidity trend line. We are waiting for more liquidity. And as you can see, price is creating perfect liquidity for this zone. In this region, we have loads of liquidity, loads of orders, loads of stop losses sitting just below this line and also just below this line. So it makes this demand zone valid. Okay. In this case, I can set an order limit on this zone and I can wait the tap of it. But actually, I believe the 2-point pip stop loss won't be enough. Yes, we will talk about the equilibrium entries in the next unit. So yeah, we did set an equilibrium entry right here. We will talk about that in the next unit. Let's see what happens next. As you can see, price is breaking structure to the upside with inefficient movements continuously, but the order is still here. We keep this order here because we have a bunch of liquidity just below this, just above this zone, and we are expecting the tap of this zone. Okay, as you can see, price reacted on this demand zone right here. And after it broke structure to the upside here again with inefficient push. Let's see what happens next. But you actually can't open a position on this demand zone. As you can see, price formed this demand zone here. But this demand zone is part of the liquidity. Can you see how many equal bottoms are here? So you can't really open a position on this demand zone. You will want to wait for a liquidity sweep. And which zone will hold the liquidity sweep? More likely this down zone. Because this zone has liquidity here, liquidity here, liquidity here. So loads of liquidity. So we are still waiting the sweep of this liquidity and the tap of this zone. And if price taps this zone and tags us in, that will be the continuation example because he missed the first entry here, couldn't enter here. And this is the next break of structure after the missed entry. Okay, so let's see what happens. Price is breaking structure to the upside. It's on the way back down to mitigate the zone. As you can see, it built up more liquidity here. Mitigated the zone, reversal. And it's on the way down to, yes, it swept this liquidity. Right now we have this liquidity left. Let's see what happens. I will just extend this line. Sorry. So yes. And I will just set my target for the next unmitigated 15-minute supply zone, which could be this one. The wick, I could use the wick. So this could be this one. And it would have been 1 to 10 risk reward ratio. Okay, that's a really good target. Let's see what happens. So as you can see, price is building up more liquidity in this region. So we have loads of liquidity, loads of stop losses sitting just below this line. And which zone will hold that liquidity sweep? This zone, right? Okay, let's see what happens next. As you can see, price perfectly swept that liquidity, tagged us in. Okay, mitigated the 50% of the whole order block. We will talk about the equilibrium entries in the next video. Don't worry. So mitigated the order block. And after it started to break structure continuously to the upside, change of character here, breakout structure. And let's just play price forward. Let's see what happens. Just extend these zones. So just play price forward. As you can see, it's moving really, really nicely, breaking structures to the upside continuously, creating inefficient movements, broke the last structural weak high. This is a weak high because it couldn't break below the last strong high. So as you can see, this is strong high because it broke the last weak high. Weak high couldn't break below the last strong low. So this is weak high. Price broke through this weak high, created another strong low. Okay, let's play price forward again. Let's see what happens. Okay, and TP hit. Perfect TP, as you can see. And this is the continuation example. So you missed the first trade right here. You couldn't enter on this opportunity because you are lack of confidence, or you're just insecure about the trade. So you are looking for a re-enter, the next opportunity. This demand zone gives us the perfect three criteria: inefficient push, breakout structure, liquidity creation, liquidity sweep. So we can set an order limit on this demand zone after all of the criteria has happened. 50% entry, bam, tag us into the trade. Target is the next unmitigated supply zone, bam, TP hit, it's all over. So yeah, meet you in the next video. Welcome to the next video. We will talk about the equilibrium entry, aka the 50% entry. Okay, the concept is the same. As you can see, price is moving in an uptrend here, creating a series of higher highs and higher lows on the 15-minute chart. So the black line is the 15-minute structure. Price created this 15-minute demand zone right here because it broke structure here with an inefficient push. And let's say it swept some liquidity from this region. Okay, so we have this really valid demand zone right here. Price came back down to mitigate this zone. And after the mitigation, it changed character to the upside here and broke through this supply zone and broke through this supply zone. So we have a valid change of character with an inefficient push. The inefficient push happened from this candle right here. And if you take a closer look, you will see that the wick of this candle is bigger than the 50% of the whole candle. So there are more wick than body. In these cases, we will use equilibrium entry. And equilibrium entry is the 50% entry. We have a simple tool for this named Gambox. Right here, as you can see, it will mark out the 50% between the high and the low. I will show you how to set this up. Here are the settings on the first box: 0, 1, 0.5, no left labels, no right labels, no background. This is a really simple setup for the Gambox. That's how I use it. So let's just pick our Gambox and use it on our box, use it on our demand zone. As you can see, it will perfectly mark out the 50% of that zone. And in these cases, when the wick is bigger than the 50% of the whole candle, we will use the Gambox and we will use the equilibrium entry. Okay, I just set an order limit here, and price has a great chance to tag us in the trade on the 50% of the zone. How can this Gambox, how can this equilibrium entry actually help us? We usually use 1.5 pip stop loss to 2 pip stop loss. 2 pip stop loss is our maximum stop loss, but we will talk about this in the money management unit. Okay, so in the most cases, these candles, these equilibrium candles, will be huge. So if you set an order limit on the beginning of this box, on the beginning of this zone, the 2 pip stop loss won't cover the whole zone, so you can't enter in a trade. You can only enter a trade if the stop loss can cover the whole zone. So in this case, we will want to use the equilibrium entry because the equilibrium entry will cover the whole zone and the stop loss will just below that zone. Okay, That's how the equilibrium entry, aka the 50% entry, can help us. That's also a golden rule. If you see a candle like this, so the wick is bigger than the 50% of the whole candle, meaning there are more wick than candle, we will always use the 50% equilibrium entry. That's a golden rule. Okay, let's see a live example for this. Okay, let's see the live example. As you can see, price created this 15-minute demand zone right here that created huge inefficient push to the upside on the 15-minute chart and broke some structure. I won't show you that zone on the 15-minute chart because that's not really important right now. We will talk about the equilibrium entry. As you can see, price came back down to this demand zone, mitigated this demand zone. And this was the last break of structure to the downside with the whole body break. This was the last supply zone, as you can see, and price broke through the supply zone. So it means it changed character to the upside. The change of character happened from this candle right here. And as you can see, this candle's wick is bigger than the 50% of the whole candle. Actually, the whole candle is just a wick. There's nobody, as you can see. So in this case, we will just pick our gambucks, mark the zone out, use our gambucks on the zone, and it will perfectly mark out the 50% of the zone, as you can see on this line. And we will use the 50% entry because the wick is bigger than the whole body. And as you can see, price perfectly mitigated the 50% of this candle. It didn't respect the top of the zone. It just came down to mitigate the 50% of this zone. So that's the power of the gambucks. That's the power of the equilibrium entries. It gives you more precise entry and gives you better and bigger risk-reward ratio, and also protects your capital from losses. So yeah, that's the power of the gambucks. Once again, the wick is bigger than the 50% of the whole candle, gambucks on the zone, 50% entry, and you are in the trade. See you in the next one. Hello, welcome to the next unit and also in the next video. In this unit, we will talk about how to manage your trades, how to buffer your stop loss and entry, and how to calculate your lot size. Okay, first begin how to calculate your lot size. This will be a really simple video. I will just tell you how to calculate the overall lot size for each position. Okay, we always use minimum 1.5 pip stop loss and maximum 2 pip stop loss. It can be smaller and can be bigger. So the minimum is 1.5, the maximum is 2 pip for every single trade. I mainly use 2 pip for every single trade, but you will just have to backtest which two is your most. Okay. To calculate your lot size, you will just have to double click on this position. For example, the stop loss level is 20 ticks. 20 ticks equals 2 pip stop loss. So knowing the fact that you are working with 2 pip stop loss, you will just have to open myfoxbook.com, click on the site. In the upper area, you will find calculators here. Click on the calculators. Click on this position size calculator. And on this site, you will be able to calculate your lot size. For example, you are trading your USD, for example, a 10K account. So you are trading on a $10K account, and just type whatever risk you are using. I'm using 1% slash every trade. So I will just type 1. This is 1% slash every trade, which it means I'm risking, for example, 100 of my whole capital, which is 10K. Okay, so your stop loss will be 2 pip stop loss. And after this, you just have to press calculate. That's all. It will calculate for you. As you can see, if I'm trading on a 10K account, risking 1% using 2 pip stop loss, I will have to open a 5-lot position in the MetaTrader application. That's all. That's the easiest way to calculate your lot size. We got one more rule for the risk-reward ratios. That rule is that the risk-reward ratio can be smaller than 1 to 5. So if I just point my mouse to this position, I will see that the risk-reward ratio is exactly 5. If this number is smaller than 5, then I just simply skip this trade. I don't enter in this trade, I just skip it. If the risk-reward ratio is smaller than 5, just skip that trade. And always keep your targets realistic. For example, I'm targeting every single trade between a 5 and a 10 risk-reward ratio. If it reaches 10 risk-reward ratio, I'm just closing the trade. You just have to keep your targets realistic. This is a really, really important rule. We are all trading for money, right? We are not trading for our ego. Just keep your targets realistic. Okay. So hello, welcome to the next video. We will talk about how to buffer your stop loss, how to buffer your entry. So overall, how to deal with spreads. This will be another short video, but this is a really important topic to understand. Okay, let's begin. If you are trading on a metaphor account, you will see something like this on your screen. As you may know, every currency pair has a spread. For example, Euro USD has 0 spread, GBP USD has 3 spread, USD CAD has a spread of 3 again, and as you can see, every other currency pair has different spreads. Okay, but how can you deal with the spreads? This is really easy. If you are selling, so you have a sell position just like this, you will have to add the spread to your stop loss. So for example, you are trading GBP USD with a spread of 3, you will have to add 3 tick to your stop loss level. So as you see, we originally used 20 ticks because 20 ticks equals 2 pips, and we are using almost every time 2 pip stop loss. So you will just have to add 3 more ticks to your stop loss level if the spread is 3. I'm adding 3 and my stop loss will be buffered. If, for example, I'm trading EUD CAD, I will just have to add 8 to my stop loss level, and my stop loss will be buffered by the spreads. Let's say we are hopping in the long and we are setting a limit order for a long trade. You will have to add the spread to your entry level. So for example, let's say we are trading GBP USD again with a spread of 3. You will have to add 3 ticks to your entry level. So as you can see, we have the entry price here. The ending is 3. We will have to add 3 more to the 3, which is 6. So this is how you can buffer the stop loss and the entry. This is a really important topic. You will always want to buffer your stop loss and your entry if you have spreads. See you in the next one, guys. So hello guys, welcome to the next video. We will talk about how to manage your running trades. Okay, so as you can see, price is moving in an uptrend here, creating a series of higher highs and higher lows. So the expectation order flow is bullish, right? We are expecting the top of this demand zone, and after the top of this demand zone, we are expecting a change of character, and after the continuation of the whole bullish order flow. Okay, as you can see, price created this demand zone right here with all the 3 criteria, and I will just tell all the 3 criteria again because it's really important part. I just want you to memorize it. I just want you to learn it, and I just want to make sure you learn all the 3 criteria about the demand zone. So okay, price created this demand zone right here because it broke structure to the upside with inefficient movement and swept some liquidity from this region, let's say. So we have a valid demand zone. Okay, so the red lines are the 15-minute structure, also this leg too, and the pullback is the 1-minute structure. So we're expecting the top of this demand zone, and after the top of this demand zone, we are expecting the continuation of the whole order flow, which is bullish. Price tapped this demand zone, swept some liquidity from this region, let's say, and after a liquidity sweep and the higher time frame demand mitigation, it changed character to the upside and broke through several supply zones. So as you can see, we have a supply zone right here. Price just broke through that supply zone. We have a supply zone right here. Price broke through this supply zone too, and change character on this region. Okay, catch up. So we have a change of character and the supply breaks, and we are expecting the continuation of the whole bullish order flow from this demand zone that has been created, because if a zone breaks, an opposite side zone will be automatically formed. That's another rule too, as you may know. Okay, so price change character tapped us into the trade because we did set an order limit on this order block, on this demand zone. And let's say we are targeting the next unmitigated supply, which could be this one. Okay. So how do we actually manage the trade after we get tagged in? So we are in the trade right now, just tagged in. And if price starts to move up and breaks through the last structural high, which is this one, so it creates a break of structure to the upside, we will put our stop loss into break even. So as you can see, price broke structure to the upside. We will place our stop loss on the break-even level. So this level, I will just mark it with a red line. So the red is the stop loss level. Okay, let's say price creates a pullback. And after the pullback, if it hits the break-even level, we will tag out from the trade with no profit and no loss. If price respects, for example, this demand zone, because we have a demand zone right here, sorry, I will just draw a demand zone right here. Let's say price respects this demand zone and reverses on it. After the next break of structure, so the break of this structural high, we will put our stop loss, BUS long. So we will put our stop loss below the next structural low, the strong low. So as you know, this is the strong low. If a structural high, a weak high breaks, we will put our stop loss below the less strong low. And this method goes on and on again. If this high breaks, let's say price respects demand zone right here somewhere, breaks the high. So this high has been broken, this supply zone has been broken. I will mark a break of structure here to the upside. We will put our stop loss below the next strong low. So this is a strong low because it broke the last weak high. And this goes on and on again. If price creates pullback and breaks structure to the upside here, we will put a stop loss below the next strong low. And this goes on and on again. Actually, I found it working really, really well. I hit way more trailing stop loss and TP than just normal stop loss. Okay, what is trailing stop loss? Trailing stop loss is this stop loss that we put underneath the weak low, strong low or strong high in a short trend. So if you are managing your stop loss, that will be your trailing stop loss. And if price breaks through this level, your trading stop loss will be hit and you will be taken out from the trade in profit, right? Okay, for me, this is the best way to maximize the profit from each trade. So I'm just using this one. I'm not taking any partials. That's not my way of trading. I like trading my stop loss. Okay, let's see some live examples for this. Okay, so that's a live example on how to manage the trades. So as you can see, price is moving in a downtrend here, creating series of lower lows and lower highs. Actually, the last break of structure happened here from this supply zone. This supply zone caused an inefficient movement that swept liquidity from this region. As you can see, triple bottoms. This supply zone swept the triple bottoms, broke structure here, inefficient movement. So we have a really valid supply zone right here. Okay, price actually came back up. Sorry, let me just zoom in so you will see it better. So price came back up to mitigate this supply zone, and after the mitigation, it reversed on this supply zone. But after the reversal, it created a flip zone, a 50-minute flip zone. So as you can see, this demand zone created huge inefficient push to the upside that changed character here and broke to the supply zone. And actually, it swept liquidity from this region. So as you can see, there's a liquidity trend line. Stop loss is just below this line. So it has this demand zone has all the three criteria again. So this is a really valid demand zone. Okay, price reached its high point here. Actually, it tapped into some sort of supply zone, reversed, and started to form series of lower lows and lower highs. Okay, price tapped into this demand zone, and on the 1 minute, you will see that there was a good entry opportunity. And let's say we entered in a trade. But first, let's mark our higher time frame target, which will be this supply zone right here, because this supply zone started the whole inefficient movement. As you can see, from this supply zone started the inefficient movement and the change of character, because this was the last demand zone and price change character here on this line, and the whole change of character and the inefficient movement and the liquidity strip from this region happened from this supply zone. Okay, so let's switch to the 1 minute, and you will see that I will just extend the target point after this supply zone. Okay, so you will see that we have a really, really great entry opportunity, and I will just replay the price here. Okay. Sorry, I will just adjust this. So as you can see, price created series of lower lows and lower highs, created the last low, this supply zone. After it broke structure to the upside, changed character to the upside, this demand zone changed character, this demand zone swept liquidity from this region. So price came back down to mitigate this demand zone, and let's say we entered in a trade here. So we are tagged into the trade right now. Okay, as you can see, we have this last strong high here. A weak high, sorry. We have this last weak high here. If price breaks through this last weak high, we will put our stop loss into break even. So on this level, I will just extend this position. So let's play price forward. As you can see, price broke through this last structural weak high. Here's a break of structure to the upside, and we will manage our stop loss into this level. How do I actually mark it? I will mark it with this Okay, so our stop loss is on this level in break even. If price creates a pullback and respects this demand zone and creates another breakout structure to the upside, we will put our stop loss into the next strong low. Let's see what happens. So as you can see, a pullback has started, and actually price created a new low because it created a pullback and small breakout structure to the upside here, but this is our new low. But in this case, I wouldn't set my stop loss below this level because this one could be liquidity for this demand zone. So I will just keep my stop loss here. This isn't a real breakout structure, it's just a liquidity built up. Okay, let's see what happens next. Price created a pullback, reacted on the demand zone. As you can see, reaction if this high breaks. If this high breaks, I will put my stop loss below this level. Okay, let's see what happens. Okay, that high has been broken. As you can see, here's a breakout structure to the upside. I will just mark it with BOS long. Okay, and I will place my stop loss below this level. So our stop loss is on this level. As you can see, we are locked in almost 3% profit. So 3% profit is already locked in. We can't lose that. Let's see what happens next. Price creates a pullback again, as you can see. Pullback, 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 pullback. Liquidity. And price broke structure to the upside again. As you can see, here's a breakout structure to the upside. Also, it happened here. So I will just place my stop loss below this. But considering the liquidity, so as you can see, we have liquidity here in this region. Triple bottoms or double bottoms, first, second, or third bottom. We can keep our stop loss on this level because if the liquidity sweep happens, our stop loss will keep us in the trade because something will hold the price here and our stop loss will be protected. But if we place our stop loss below these equal lows, we have a high chance that we'll be swept out. So let's just keep our stop loss here and wait for another structure break. As you can see, pullback happens and breakout structure to the upside again here. And in this case, I will just place my stop loss below this low or this low. So in this case, we will have maybe 5% locked in. Yes, 5% profit locked in already. So let's see what happens next. If price breaks structure to the upside again after the pullback, we will play. Yeah, breakout structure happened again here. So here's another breakout structure. I will just place my stop loss here. But as I said, we can consider liquidity. As you can see, we have liquidity again here, and we can just keep our stop loss on this line again. So we won't be part of the liquidity with our stop loss. If price breaks another structure to the upside, I will just place my stop loss below these lows. Let's see what happens. Pullback happened and another breakout structure happened. So I will just place my stop loss below this line. Okay, let's see what happens. Another pullback, another breakout structure to the upside. We can do the same. We can keep our stop loss here if we are afraid from the liquidity, but I see no liquidity here. There's no double bottoms. This could be just a small pullback. So I'm placing my stop loss below this level. And if my stop loss hits, we will hit maybe 8% profit or 7%. Yeah, 8% profit. So we have a trailing stop of 8% profit. Let's see what happens. Price creates a new high, another pullback, another breakout structure to the upside. Actually, I will just keep my stop loss on this region because this could be liquidity for this demand zone. So I will just keep my stop loss here. Okay, let's see what happens next. Yeah, small pullback. And as you can see, if I would have placed my stop loss in this region, it would have been stopped out because price is sweeping this liquidity right now. That's why I kept my stop loss here. Let's see what happens. As you can see, price swept all of the stop loss levels. And if this breaks structure to the upside here, I will place my stop loss below this level. Let's see what happens. It broke structure to the upside, and as you can see, I will just draw a line here. So this is our stop loss level, and it perfectly kept us in the trade. So a breakout structure happened here to the upside. I will just place my stop loss below this low now. So our stop loss level on this region. Okay, let's see what happens. Breakout structure to the upside here. Pullback started. Pullback started. Huge pullback. If this high breaks, I will place my stop loss below the next strong low. Let's see what happens. Okay, as you can see, a low has been created, a strong low again. This strong low broke the structure to the upside. So here's a breakout structure. I will just place my stop loss below this level. And if that stop loss hits, I will be in almost 9% profit. So that's really good. Let's see if another pullback happens. Actually, it's building up liquidity again in this region. I think it will go straight up to the TP. Yeah, straight up TP, TP hit. And actually, that's how you manage your stop losses. The same concept goes on for the short trades. So let's say change of character happened here. Judge down after a higher time frame supply mitigation. So we have a change of character. Let's say you entered on a freshly formed supply zone here. You entered in a short position on this supply zone, and you're targeting the next unmitigated higher time frame demand zone. Okay, if this low breaks, this one, you will put your stop loss into break even. So breakout structure here, stop loss into break even. Breakout structure here, stop loss here. Breakout structure here, stop loss here. So the same concept goes on for the short opportunities. Okay, see you in the next one, guys. Hello guys, welcome to the next unit. In this unit, we'll put all the concepts together and see a complete example for the trading plan. Okay, so let's just begin. As you can see, here's the whole trading plan I use. The first point of the plan is that I check if there's any upcoming news for that day, any upcoming high impact news to be more precise. It means that before you do your markups or do anything related to trading, you have to open forexfactory.com and check the upcoming high impact news. So I will just open forexfactory.com, as you can see, and on the front page, you'll be able to see the upcoming news, which are these. Let's say it's the 4th of January and you are trading on this day. The first thing you have to do is checking the upcoming high impact news. On this day, there will be 3 high impact news marked with red folders. As you can see, these are the red folder news, are the high impact ones. We have a golden rule for high impacts. The rule is that we don't trade during these red folder news. Just don't open any position in that time window. Monitor the market, but just don't open a position. That's the golden rule here. If there aren't any upcoming high impact news, you can safely trade as usual. So you did the first point, you check the high impact news. Let's see the second point. The second point is the 4-hour supply and demand markup and determining the overall market direction. Knowing the higher time frame direction is necessary if you want to be successful in trading, especially in this 1 minute lower time frame strategy. Okay, so let's see an example, a whole example for this second point. Okay, so let's see the live example for the supply and demand markout and determining the overall time frame direction on the 4-hour chart. So as you can see, we are currently on the 4-hour chart. And if you take a closer look, you will see that price is moving in an extremely bearish trend, creating series of lower lows, lower highs. And if I just focus on this region, you will see that price is respecting supply zones over and over again, breaking structures to the downside. As you can see, we have this supply zone right here, broke structure to the downside here, supply zone respection here, another break of structure to the downside, another supply zone respection. So we are moving in an extremely bearish trend. We can identify this by looking at the chart simply. Okay, but let's focus on this region. Because as you can see in this region, price is moving in aggressively bearish. So it's creating breakout structures to the downside again, sweeping liquidities, breakout structures here, respecting supply zones or mid-zone areas, breakout structure to the downside, respecting supply zone, breakout structure to the downside, small pullback, breakout structure to the downside, small pullback, respecting supply zones. And actually, let's focus on this region now. So as you can see, we had this supply zone right here that price just respected after the breakout structure. So here was the breakout structure, and the breakout structure happened from this supply zone. Let's see if it swept any liquidity. I will just put my marker right here, and let's see if it swept liquidity. As you can see, it actually swept small liquidity from this region. When price was moving in an uptrend, it actually swept this trendline liquidity, and we had this double bottoms on the 4-hour chart, as you can see. So it swept liquidity, created inefficient push to the downside, because here's the inefficient push to the downside. Here's the break of structure. Here's the liquidity sweep and the liquidity sweep from that demand area. Okay, so price just did a break of structure, and actually it could have reversed on some sort of demand zone right here. Okay, we have to find that demand zone. I will just put my marker right here, and let's see if there's any demand zone in the back region. Actually, there is, as you can see, here's this perfect wick that perfectly reversed the price to the upside. Because as you can see, this wick created an efficient push to the upside here, also broke some structure. So this isn't the most valuable demand zone because it doesn't have all the 3 criteria, but it is still a demand zone because it could have reversed the price. Okay, so I just extend this zone. So I just extend this zone and remove this line from here. Okay, so as you can see, price tapped into this zone here and reversed to the upside to tap the supply zone and continue the overall bearish order flow. So in this region, after this demand tap, you had room, you could have room to trade long trades between this demand zone and between this supply zone, but those are counter trend trades. Our main trend here is bearish. It's creating a series of lower lows, lower highs. So the overall main trend is bearish. These downside movements are the main trend movements, and the small pullbacks are the counter trend movements. So you actually had room between this demand zone and this supply zone to trade long trades up to this supply zone, right? But the main direction is bearish, so we want to see short opportunities. Okay, so let's say you open the trade here because there was a 15-minute change of character inside of this 4-hour supply zone, and after the 15-minute change of character, there was a 1-minute change of character inside of the 15-minute supply zone. So you entered here, it pushed the price to the downside, created inversion movement here, broke structure here. So it means price created another supply zone. As you can see, it created huge inefficient push to the downside, break of structure, actually swept liquidity from this region, created liquidity here. Here's a liquidity trend line. Also liquidity, liquidity, liquidity. So there are loads of liquidity sitting in this region, waiting for the supply to be tapped. As you can see, this could be our correct supply zone because this supply zone caused the inefficient push to the downside. So I will just mark it out as our 4-hour supply zone. Okay. So actually price broke through this demand zone, as you can see. So demand broke. That means an opposite side zone has been created, which is this supply zone up here that has all the 3 criteria. Let's see if price tapped into another demand zone right here. I will just put my marker again here and see if there's any demand zone that price has tapped. As you can see, we have this weak zone again. This one, I will just change the color to blue. So we have this weak zone right here. That this isn't the most valuable demand zone again, so it more likely will be broken and price will break through this demand zone after the reaction. Sorry, so price will break through this demand zone after the reaction. As you can see, it just did a small change of character or break of structure to the upside with not much of an inefficient push, small liquidity sweep. So yeah, this range, this region is just a range, and range and demands in ranges aren't the most valuable demand zones. Okay, so I just extend this zone here again. As you can see, price was perfectly reversed on this zone. So once again, price created this supply zone, inefficient push, break of structure, liquidity creation everywhere. So this is just a whole big liquidity pool needs to be filled. After the demand break, this demand break and the inefficient push, price tapped into another demand zone, and the demand zone reversed the price again to the upside. So you had room between this demand zone and this supply zone to trade long opportunities again, but those are counter trend movements. Just notice this, every long trade in this trend is counter trend movement. The main trend movements will be short trades. Main trend movements are more impulsive, has more volume, and safer to use. So, as you can see, price stepped into this supply zone, the 4-hour supply zone that we just marked. Right now, we are waiting for a reversal inside of this 4-hour supply zone on a 15-minute chart or a 1-minute chart. And as you can see, there's one more important thing to be noticed. We have triple taps on the 4-hour chart. So as you can see, we have the first tap here. This is the first tap. We have the second tap here. And the third tap has been just formed. So we have a liquidity line on the 4-hour chart, which means price has a really high probability to sweep all of this liquidity before the reversal to the downside. Okay, so here's the liquidity. So the possible scenario here is that price maybe reverses on the supply zone, and after the reversal, it will sweep all of the liquidity from above this line, collect all of the stop losses, collect all of the orders. Just imagine how many millions and trillions and billions of dollars are sitting just above this line. This is a 4-hour chart. Literally trillions of dollars sitting just above this line. Price will sweep all of this liquidity in order to continue the whole bearish trend. So it has to collect the orders, has to collect the stop losses in order to open more positions, open more sell positions. And after the sell position collects and everything, price could reverse to the downside. Okay, so we actually marked out all of the 4-hour zones. Maybe we can mark out demand zones in this region. So as you can see, price was moving in a downtrend here. After this price change character, this was the last supply zone right here. And this demand zone right here changed character on the 4-hour chart. As you can see, it caused huge inefficient push to the upside, change of character here, here, here. So basically change character everywhere. So this will be a valid demand zone. After this supply has been tapped and the 15-minute change of character happened, we can target this demand zone right here, or maybe another decisional demand zone, because as you can see, we have a decisional demand zone right here, but price has a really great chance to sweep this demand zone, because if you take a closer look, this is just liquidity again. That's what I was talking about in the liquidity unit, because as you can see, we have triple bottoms here again, first bottom, second bottom, third bottom. So this is just a huge liquidity line lined up with the demand zone. So price has a great chance to sweep the liquidity from above this supply zone. After the reversal, sweep the liquidity from below this demand zone. So sweep all of the liquidity. And what could hold the price after the downside liquidity sweep? This demand zone could easily hold the price, right? So this could be your first target after the enter on this region. So once again, liquidity sweep. After the liquidity sweep, reversal on the 15-minute chart and on the 1-minute chart. And after the reversal, you can enter in a trade, in a short trade, and target this demand zone. Okay, so I believe we marked all of the zones out inside of this region. These zones are irrelevant because they have been already mitigated by the following price action, as you can see. So this supply zone is mitigated by this is mitigated by this is mitigated by this. So the only unmitigated areas left are these zones. Okay, let's see the third point. Okay, so let's see the third point. I will just paste the print list here. As you can see, the third point is finding the 15-minute supply and demand zones and marking them up. Okay, this is a really simple task. Let's see the structure first. As you can see, this was the 4-hour supply zone that we just marked on the 4-hour. This caused the breakout structure on the downside in the 4-hour chart. Here's the 4-hour liquidity line, the first tab, second tab, third tab. This was the first extreme demand zone that changed character on the 4-hour chart here. This is the 4-hour decisional demand zone with liquidity just below the zone. So yeah, let's see the price action. As you can see in this region, everything is mitigated. So all of the supply zones inside of this region are mitigated by the following price action, as you can see. So all of the zones in this region are efficient and mitigated. So we will have to focus on this zone. Okay, price is actually in the 4-hour supply zone right now, as you can see. And if I zoom in, you will see that price created the fourth tap here. So we have 4 taps, 4 equal taps. So imagine how much liquidity are sitting just above this line. Price have to sweep that liquidity. Okay, but mark out the zones. Focus on the most relevant zones. As you can see, price was creating a series of higher highs and higher lows in this region, starting from this extreme demand zone. And actually, price change character here on the 50-minute. This is a 50-minute change of character. I will just mark it here as a change of character down. So price change character on the 15-minute chart with inefficient push, as you can see. Actually, the first change of character happened here because this was the last upside candle and the last reverse before the last high has been reached. And this supply zone changed that character. I will just mark that supply zone here. And we'll just zoom in. So this supply zone changed the character first. This decisional zone broke structure here and changed the bigger character. So we have two supply zones right here, as you can see. I will just mark the decision out too. So yeah, after this, price started to do a bearish trend here on the 15-minute chart. But price tapped into this demand zone right here, tapped into this demand zone, and change character to the upside after the tap of this demand zone. As you can see, this demand zone is really valuable because it's fat liquidity here, created inefficient push to the upside, and had the liquidity just above it, and multiple liquidity lines everywhere. So this is a really valuable demand zone. Price tapped this zone, and after the tap, it reversed to the upside. Okay, so in this region, price is moving in an uptrend, so it's bullish. But knowing the fact that the overall time frame direction, so the overall 4-hour direction is bearish, we know that taking long trades in this region are counter trend movements, right? So everything that has been taken on the long side is a counter trend movement. But you can still take it, but you just have to know the fact that you are trading a counter trend movement and it has less chance to hit TP than the main trend movements. Okay, so we marked out this demand zone. As you can see, it reversed the price here, change character to the upside again here. So here's a change of character up. And actually, this demand zone right here caused the inefficient push and change of character to the upside. And as you can see, price reacted on this demand zone here, just a wick below. So this isn't a real break because, as I told you, the wicks below are just liquidity sweeps. So it could have been a liquidity sweep from this region, could have been a liquidity sweep from this region. So these are just liquidity sweeps. Okay, price actually reversed on this demand zone, as you can see. I believe there was a 1-minute change of character inside of this zone. And after the 1-minute change of character and the entry opportunity, price started to form series of higher highs and higher lows. Okay, let's focus on the supply zones. As you can see, this supply wick is a flip zone. Also, this supply wick is a flip zone too, but this is less valuable because it didn't have that much reaction than the extreme one. So, okay, I will just delete this one and focus on the extreme one. So, as I told you, this supply zone changed character to the downside first here. And as you can see, after the demand change of character, price started to form series of higher highs and higher lows and tapped into this supply zone. Okay, let's focus on that region. As you can see, price tapped into this zone, did a reaction, rejected on that zone, and after the rejection, it just blew to the upside and created this demand zone. So this will be our 15-minute flip zone. One more noticeable thing, that 15-minute flip zones are really, really strong. You have to focus on the 15-minute flip zones every time. Just mark them out and remember the zones that are flip zones. Okay, so this is the 15-minute flip zone. This is the 15-minute demand flip zone that caused the tap of the 4-hour supply zone. As you can see, this was the tap of the 4-hour supply zone, and it happened with a huge inefficient push to the upside. And it actually swept liquidity from this region, and also it swept liquidity from this region also. So yeah, we have this demand zone right here. And below this demand zone, we can find several demand zones. For example, this one, but this isn't as valuable as this one because this is the flip zone. This is the major demand zone. These demand zones just broke structure to the upside with inefficient push. Of course, they are valuable. They also swept some liquidity from this region. They are valuable, but not as valuable as this one. Okay, let's mark out all of the demand zones. As you can see, we have this one here also. And maybe this one too. So we have 4 demand zones, 4 15-minute demand zones. Okay, but we will focus on this one. This could be our later target point for the shorts. As you can see, price didn't really change character here. I could call it a pullback instead of a change of character. But as you can see, price created a new high, body break here. And after the body break and the wick above, it created a false change of character to the downside. And after the false change of character, it's coming back up to collect more orders on this zone, because just imagine how many sellers are opening positions on this week, because they thought that this is a change of character on this 15-minute chart, but they didn't notice the 4-hour liquidity line from above this supply zone, right? So market is just collecting more liquidity to be swept. So we are collecting more liquidity, and we are expecting the sweep of this liquidity because more sellers entered on this line, more sellers entered the market on this supply zone. So yeah, the next thing we have to do is wait for the liquidity sweep. But we will do that on the 1-minute chart. So we marked out all of our 15-minute zones. Maybe we can mark this zone out also, but this will be inducement for the downer areas, for these areas. Okay, let's see the next step. Okay, so let's see the next point. As you can see, the fourth point is refine all the 15-minute supply and demand zones on the 5-minute chart. So this will be easy. We already talked about refinements. So let's just begin. As you can see, currently we are on the 5-minute chart, and these were the unmitigated demand zones that we just marked previously. So we will have to refine these zones. Okay, let's begin on the first one. The first one is the flip zone, as you may know, because this 15-minute demand zone flipped the 15-minute extreme supply zone. So this was the 15-minute extreme supply zone that changed character on several places here. So this will be our most valuable 15-minute demand zone, and this will be our later target point. Okay, so let's just refine it. If I zoom in, you will see that we have a clear refinement inside of this 15-minute zone, this bigger zone. We have a smaller 5-minute candle, this one, and the inefficient push and the breakout structure and liquidity sweep started from this candle. So this will be our perfect refinement. As you can see, we can refine this candle for this downside candle, and I will just type the 15-minute flip zone 5-minute refine. Okay, let's see the next zone. The zone below this one is this zone. As you can see, inside of this 15-minute zone, we also have a clear 5-minute demand zone, this downside candle, because the inefficient push and the breakout structure and the liquidity sweep start from this candle. So as you can see, huge inefficient push to the upside. Here's the breakout structure. Again, here's the liquidity sweep because there's double taps. So we have a clear refinement again. We can just use this candle as our 5-minute refinement. I will just type 5-minute refine again here. And that's it. Let's see the next zone. So this will be our next zone. And as you can see, inside of this 15-minute POI, 15-minute demand zone, we have inefficiency again because inefficient push started from this candle, from this upside candle. As you can see, here's inefficiency because the wicks between the candles doesn't meet in the middle. So we can use this candle as our 5-minute refinement. It also broke structure. This was the candle that started the whole order flow that broke structure here. And yeah, it actually swept some liquidity from this region, but it is not as valuable as the 15-minute flip zone here. So this one, but we can still refine it. Okay, let's see the next one. As you can see, I will just zoom out first. So these are the refines that we just did recently. I will just type 5-minute refine again here. And as you can see, this is the last 15-minute zone that we have to refine. And inside of this zone, we will have a clear zone again. So the inefficient push started from maybe this small candle. As you can see, the wicks doesn't meet in the middle. So the inefficient push started from this candle, and the breakout structure and the liquidity sweep also started from this candle because here's the double tap, here's the breakout structure. But if you don't want to use this small candle, you can just simply use the bigger candle like this, because the taps are almost equal and the inefficient push started from these taps. So if you don't want to use this small zone, so this small zone, you can just simply use the bigger one. Okay, so the next one, this big zone, is the 4-hour zone. And actually, if you want to refine this 4-hour zone, you can refine it on the 15-minute chart. I usually just leave my 4-hour zones the way they are. So I don't really refinement. But if I take a closer look, you will see that inside of this 4-hour zone, we will have, for example, this 15-minute zone for a refinement, because the inefficient pool started from this candle, and also it changed character here. So yeah, I will just keep it like this. I won't refine it, but if you would like to refine the 4-hour zones on the 15-minute charts, you can of course do that. So yeah, let's switch back to the 5-minute chart. So these are our refinements. These are all the 5-minute refinements. And the next step, actually you can mark more 5-minute zones out on the 5-minute chart that weren't appear on the 15-minute chart. So if I like to, I can mark 5-minute zones out. For example, here's a clear zone. As you can see, this zone is clear because it started an efficient push here and swept these double taps and broke structure here. So actually I can just mark this 5-minute zone out if I'd like to. And it also has liquidity just above it. So here are liquidity, as you can see, this upside candle created a small pullback here and created the first bottom. And this pullback created the second bottom. So this zone has liquidity. But if price reverses, I believe after the liquidity sweep, so price reverses, it will hit the 15-minute flip zone, because this flip zone has so much power. It flipped the 15-minute supply zone. So I believe if we enter in shorts, we will target this 15-minute, sorry, this 15-minute flip zone. So yeah, actually you can mark out more 5-minute zones if you'd like to, but in this case, I find it unnecessary. So let's just skip this part and jump to the next point. Okay, so let's see the next step. As you can see, it's switch to the 1-minute chart and mark up any potential 1-minute zones that could lead to the 5-minute zones. Okay, so basically we are waiting for, sorry, I just replay the price. Okay, so basically we are waiting for the liquidity sweep from above this region. So as you may know, there are 4 equal taps on the 4-hour chart, on the 15-minute chart, on any chart. So there's huge liquidity on this line. So basically we are waiting for the sweep of this liquidity on the 1-minute chart. And after the 1-minute chart sweep, we will wait for a 1-minute change of character to the downside. And after the change of character to the downside, which will happen somewhere around here, after the change of character to the downside, we will have a supply zone that change character. And after a supply zone that change character, we will look for a short opportunity on that supply zone, and we will target the next unmitigated demand zone, which will be this one in this case, because this is a really, really strong 15-minute flip zone that I just talked about. So once again, 1-minute change of character and liquidity sweep happens after a supply zone will be formed, enter on that supply zone and target the next unmitigated zone. Okay, but actually, why are we waiting for short opportunities? Let me just talk through this again, switch to the 4-hour chart. And as you can see on the 4-hour chart, the trend is extremely bearish, right? So as you can see, the movements on the 4-hour chart are bearish movements. The main movements are bearish movements. All of the downside movements are huge, inefficient, high volume movements, breaking structures and sweeping liquidities, inefficient movements. And all of the upside movements are just small pullbacks with no inefficiency, no volume. So as you can see, all of the downside movements are huge inefficient movements. All of the upside movements are small pullbacks, downside movement, huge inefficient movements. And this is our pattern right here. We are looking for short opportunities. And on the 15-minute chart and the 4-hour chart, we have a huge liquidity line just above the 4-hour supply zone. And this will be the perfect opportunity for the short entries. Price will sweep this liquidity, and after the sweep, it will create a change of character and happen a trade. This is our perfect pattern here. Okay, so let's just switch to the 1-minute chart and actually play price forward. We are waiting for the 1-minute sweep, waiting for the sweep on the 1-minute chart. On the 15-minute chart, it will look like just one big candle that sweeps the liquidity with the wick, and after it will reverse, but we can catch a good anti-opportunity on the 1-minute chart. So this is the liquidity line right here. Let's wait for the sweep. Okay, small pullback. And actually the sweep happened, as you can see. And this was the last demand zone that created the sweep and the breakout structure to the upside. Let's play price forward. Price swept this liquidity line, as you can see. That's what happens next. And as you can see, price broke through the last demand zone that created the liquidity sweep and the breakout structure to the upside in 1 minute. And price swept all of the liquidity from above this line, swept the trillions and trillions and trillions of dollars from above this line, from above the supply zone. And after the liquidity sweep, it reversed immediately, as you can see, with huge inefficient move to the downside and broke through the last demand zone. And actually it broke through several demand zones because we had this demand zone right here. So yeah, this means a demand zone has been broken. This means we have a supply zone. Sorry, the recording stopped suddenly. I don't know why, so let's just continue. So as you can see, this demand has been broken. So it means a supply zone will be automatically formed, because if a zone breaks, an opposite sign zone will be formed. Okay, so here's a change of character. As you can see, price change character here because it broke through the last structural low point. And this was a strong low point, as you can see, because it created the last high point and swept liquidity from this region. So price just broke through this demand zone. Okay, let's find the supply zone that caused the break of this demand zone. As you can see, here's an inefficient push that came into the market. Here's the liquidity sweep from this region. Here's the change of character. So which supply zone caused this change of character, inefficient push, and liquidity sweep? This upside candle has been already mitigated by the following candle, right? But the following candle is already inefficient. So this is all inefficient. So in this case, as I told you, we have to use the wick as our right zone, because this candle is mitigated by the following candle. So the wick is the only unmitigated area. Okay, so I will just mark it out as our supply zone. And I will set my order limit on this zone, a sell limit, and I will set a 2 pip point stop loss. So as you can see, the 2 pip exactly covers the zone, so we can use the 2 pip stop loss. And if we would have used the full body, which is not correct in this case, the 2 pip would not be enough, as you can see. It's already almost 5 pips. So the only right zone here is the weak zone. Okay, I did set an order limit on this zone, and I will target the next unmitigated 15-minute zone, which is our flip zone. Okay, this is a really, really strong flip zone. We just extend the position a little bit, and let's play price forward. Okay, so as you can see, the pullback happened. Price created liquidity for this zone, so that's perfect. As you can see, here's the first tap, here's the second tap, so we have liquidity just below this zone. So we have perfect liquidity, perfect zone, perfect inefficient push, change of character, break of the demand zone, liquidation of the 4-hour liquidity from above this line. So this is a really, really perfect textbook setup, right? Price flat higher time frame liquidity, created inefficient push to the downside that changed character, broke through the last demand zone, created liquidity just below the freshly formed supply zone. So yeah, I did set an order limit. Let's see what happens next. Price is coming up to mitigate the zone, almost mitigated the zone, and reversed immediately. Okay, let's play price forward. And price has been left without us. As you can see, price didn't actually tap our entry point and left without us, but that's perfectly fine. Let me tell you why. I wanted to show you that you'll miss loads of trades and opportunities. You have to get used to this. I also wanted to show you that Forex trading isn't always fun and easy. You'll miss huge opportunities like this, and you'll get stopped out a lot of times, but that's all good. All you have to do is follow the trading plan. If you follow your trading plan, no matter what, you'll find consistency on the long run. That's the #1 most important rule. Follow the plan no matter what. Get used to losses, get used to misses, and leave your emotions out of this game. In this example, we followed the plan. Price gave us an incredible opportunity, but didn't mitigate the POI. It is what it is. At least you'll know that your analysis was on point, right? You have to adapt and focus on your next trade. So that's perfectly fine if you miss a trade like this. Don't stress out. Don't think about it too much. Just adapt, close your position, and monitor price. You can mark up new zones. You can find new opportunities, and that's perfectly fine. Okay, let's do another example, but now with a tag. So hello, welcome to the next video. Let's do the next example for the whole trading plan. Okay, So as you can see, the structure is the same, just like in the previous example. Price is moving in an extremely bearish trend, creating inefficient movements to the downside, breaking structures to the downside over and over again, respecting supply zones over and over again, breaking through demand zones over and over again. So the structure is still extremely bearish, as you can see. We have these two 4-hour demand zones marked out again, just like in the previous example. So I won't show you that again. So okay, let's map out our structure. As you can see, price is moving in a downtrend, creating a series of lower lows, lower highs, and price is respecting its supply zones over and over again. We had this last supply zone right here. Price reacted on this supply zone after the inefficient push to the downside and the demand tap. So price actually tapped this demand, reversed on this demand zone, and after the tap of this supply zone, it reversed again to the downside and did a break of structure with this movement, with this wick. Because as you may know, break of structure won't be a break of structure if it breaks with a wick. So this wick wasn't a break of structure, it wasn't a demand break, it could have been just a liquidity sweep or anything. So as you can see on the 4-hour chart, price tapped this demand zone first, rejected on it, tapped the supply zone, tapped the demand zone for the second time, rejected on that demand zone again. And after the rejection, this demand zone has been broken, as you can see, with an inefficient push. Let's see which 4-hour supply zone caused the break of this 4-hour demand zone. Because if a zone breaks, an opposite side zone will be automatically formed, as you may know. So as you can see, the inefficient push came into the market from this upside candle. And this upside candle has been not mitigated yet. So this is our right supply zone in this case, because inefficient push came into the market from this candle, break of structure here, liquidity sweep from this region and also from this region. And it actually didn't tap into the next 4-hour demand zone. So we will have this right supply zone. I will just mark out this as a 4-hour supply zone, as you can see. And price actually tapped this zone and had a small rejection on it. Right now, we have to switch to the 15-minute chart and mark out all of the 15-minute zones. Okay, so as you can see, price rejected on this 4-hour supply zone here. And if you take a closer look inside of this 4-hour supply zone, there will be a really, really clear 15-minute supply zone, this one. And price actually tapped this zone also, not just the 4-hour one. As you can see, price exactly tapped this one and reversed on this zone. So this is a really, really strong confirmation for the shorts. So price tapped the 4-hour flip zone, because this 4-hour supply zone flipped the 4-hour demand zone. So this will be a really, really strong zone. If price rejects on this zone, we will know that we will look for a short opportunity and short confirmations. And inside of this 4-hour zone, price tapped the 15-minute supply zone. I will just mark it with this line. Okay. So as you can see, price just tapped this zone, and after the tap of this zone, it immediately reversed and had a really, really strong reversal and inefficient push to the downside. Okay, so right now we are on the 15-minute chart. We have to find all of the supply and demand zones on the 15-minute chart. Okay, so let's begin. As you can see, these areas, these zones are mitigated by the following price action. So this upside price action. So we will have to find for demand zones. Okay, as you can see, here's a demand zone that created huge inefficient push to the upside and changed character. I will just mark it as a demand zone and change the color to blue. So as you can see, here was a downtrend, inefficient push to the downside, downtrend, break of structure here, less break of structure, and this demand zone flipped this supply zone. As you can see, we have this supply zone that created the less low and created the less break of structure to the downside. And this demand zone reacted on this supply zone and flipped it with a huge inefficient push to the upside and liquidity sweep from this region, liquidity sweep from this region, change of character here, change of character here. So this is a really, really strong demand zone, as you can see, and price reacted on this demand zone immediately. And after the reaction, it pushed to the upside and tapped the 4-hour and the 15-minute supply zone that flipped the 4-hour demand zone. Okay, so after this demand zone, we will have another demand zone, which caused the inefficient push to the upside. And this will be the demand zone. As you can see, this is a really, really huge zone. So we will have to refine it on the 5-minute chart. And actually, we have another hidden demand zone. If I just zoom in, you will see that here's an inside bar. As you can see, inefficient push came into the market from these two candles. And this candle closed lower than the last high of the previous candle. So this means this is an inside bar, and we have a rule for this. Every inside bar is a supply or demand zone. So I will just mark this demand zone out. This will be our last demand zone, and price actually changed character here and broke through the last demand zone. So we will have a right supply zone. Actually, I can just mark out this zone as our supply zone, but I will just rather use the 5-minute refinement instead, because this is also a really huge zone. And this zone is also inside of the demand zone. So the next step is to refine all of these zones on the 5-minute chart. Okay, so let's refine all of the 15-minute zones on the 5-minute chart. And as you can see, price actually tapped this 15-minute zone already, so there's no point to refine that zone, because a huge recovery and huge reversal already happened on the 15-minute zone. So there will be no point to refine that 15-minute zone on the 5-minute chart, because as I said, reversal has been already happened. So, okay, let's start the refinements on the 5-minute chart. So this zone has been already mitigated, and this is the refinement of that zone, because the inefficient push came into the market from this candle, as you can see, and this was the last 15-minute supply zone that created the last 15-minute low here and the last break of structure. And this candle, as you can see, flipped that 15-minute supply zone. So this is a really strong zone. Okay, price mitigated this zone, and let's refine the next zone after this demand zone. And this is the next 15-minute demand zone after this zone, and the refinement will be really clear. As you can see, we have a crystal clear zone inside of this 15-minute zone, which is this one, because huge inefficient push came into the market from this candle. As you can see, inefficiency here, and it broke structure to the upside. It slapped liquidity from this region, first, second, third tap. So it slapped liquidity, broke structure here to the upside. So did everything. This is a really clear zone again. This could be your later target point for the shorts. So if price comes back up to the supply zone, mitigates the supply zone, and creates a 1-minute change of character also, we will have in a short trade and we will target this demand zone. There will be a huge room to enter in the trade, because the movement between this supply zone and this demand zone will be around 10 to 15 risk reward ratio, which is huge, which is really great. We do not trade for ego, right? We trade for profit, we trade for money, and 10%, 15% on a single trade in minutes is extremely good, right? We can all agree in this one. Okay, so let's just continue. Refine this 5-minute zone. And as you can see, here's the inside bar. Here's the 15-minute inside bar. And actually price changed character on this zone, because as you can see, price actually broke this last high point. This was the last high point, and the break of structure came into the market from this week or this candle, because price broke the structure to the upside with inefficient push. Here's an inefficiency, as you can see, and it body broke a bow and tapped this last supply zone, the refined 4-hour supply zone. And after a tap of this 15-minute supply zone, price reversed and changed character immediately and broke through supply zone. I mean the demand zone, as you can see. So if your demand zone breaks, a supply zone will be opportunistically formed, as you may know. So I marked out on the 15-minute this supply zone as our character changing supply zone, but we can refine this on the 5-minute also. So this is our refinement. As you can see, it's crystal clear again, because inefficient push came into the market here, change of character came into the market here, liquidity sweep came into the market here, swept liquidity, broke demand, broke structure, changed character, created inefficiency. So all of these movements are started from this supply zone, this 5-minute supply zone refinement, right? Okay, so here's the plan. We are waiting for the tap of this supply zone on the 1-minute chart, and after price tap this 5-minute supply zone, we will wait for a 1-minute change of character. So the 1-minute structure will look like this. Price tap this supply zone, creates a change of character, and then the freshly created 1-minute supply zone, we will enter in the trade and we will target this 15-minute demand zone. This is the master plan here. It's really clear and simple, right? Let me just walk through this again. So we had a 4-hour supply, 4-hour demand zone. Price broke through this 4-hour demand zone with a 4-hour supply zone. Inside of that 4-hour supply zone, we had a 15-minute supply zone that created huge inefficient push to the downside and break of structure and demand break. After this, price created an upside movement, levitated back up to this 15-minute and 4-hour supply zone. price tapped both of the zones, swept liquidity from this region, changed character after the supply zone tap, the 15-minute supply zone tap, it changed character on the 15-minute and the 5-minute structure. After it created inefficient push to the downside, swept liquidity, created a fresh supply zone, and we can wait for a supply to be tapped and enter on a 1-minute chart with or 1-minute entry models. Either if it's a flip, either if it's a change of character, either if it's a continuation, we will enter in a trade. That's our master plan here. But one more noticeable thing, we can also miss this trade, just like the previous one. There's a chance that we'll miss this trade. This is also a textbook example, but there's a chance we will miss it. Okay, so let's see the 1-minute structure. Okay, so let's see the 1-minute structure. As you can see, this was the last 5-minute demand zone that created a new high on the 5-minute chart. And also this was the 15-minute inside bar that we just refined on the 5-minute chart. Okay, this was the 15-minute supply zone, and this is the 4-hour supply zone. As you can see, price actually tapped this 4-hour supply zone after a huge inefficient push. And this was the last demand zone that caused that push. So here's the last demand zone on the 1-minute chart that caused the less inefficient push that tapped us into the 4-hour supply zone. And instead of breaking below this demand zone and breaking below the strong low, because this is a strong low, it created a new high. So instead of breaking below the strong low and the demand zone, price created liquidity, as you can see. Here, liquidity on the downside, and here liquidity on the upside. So we have triple taps on the upside, triple bottoms on the downside. So this means this liquidity have to be swept on both sides, right? Okay, as you can see, price tapped the zone first, couldn't break above the last high point, couldn't break above it. It tried once, second, and third time, but it couldn't break above. And the final push came into the market from this candle. Sorry. So the final push came into the market from this candle. As you can see, this was the 1-minute zone that created the last high and breakout structure and liquidity sweep. Okay, but right now we are in the 4-hour supply zone, and in a 4-hour supply zone we have to wait for a 15-minute or 5-minute change of character, as I told you, right? So 5-minute change of character happened from this supply zone, and this supply zone flipped the 5-minute demand zone. So we are waiting for this supply to be tapped and not the 1-minute supply zone that flipped the 1-minute demand zone, because we are inside of a 4-hour zone, right? This is a really important part, because this supply zone, this 5-minute supply zone, changed character on the 5-minute and changed character on this 5-minute demand zone. Because we are inside of a 4-hour supply zone, we have to aim for this supply zone, and we have to search for a reaction on this supply zone and change of character on the 1-minute structure on this supply zone. And we are not aiming for 1-minute zones right now. So these zones are irrelevant right now. We are aiming for this one. Okay. So I will just play price forward and wait for a reaction on this zone. So let's just play price forward. One more thing, as you can see, price actually broke through this demand zone also. So this is a really, really strong confirmation that the trend might be changing from bullish to bearish, right? Because price broke through several demand zones, either on the 1-minute, either on the 5-minute, and broke through many demand zones, swept loads of liquidity from here, from here, from here. So yeah, the trend might be changing from bullish to bearish. And the overall high time frame trend, so the 4-hour trend, is still extremely bearish. Remember, we are aiming for short opportunities because the overall structure, the overall trend on the 4-hour chart is extremely bearish. Okay, so let's just play price forward. As you can see, price is ranging now. Swap this upside liquidity with this movement on the way to tap the zone, and the zone tap actually happened, as you can see. Let's wait for, okay, a huge reaction came into the market, as you can see. And sorry, I will just replay price here. As you can see, this was the last demand zone that tapped us into the 5-minute supply zone. So this demand zone was the last zone that created inefficient push, break of structure, and liquidity sweep, and tapped us into higher time frame 5-minute zone, right? Let's just take a closer look. As you can see, here's liquidity. First, second, third tap. So here's a liquidity line. Here's inefficient push. Here's break of structure. So this is a really valuable demand zone. Okay, as you can see, price reacts on this zone, right? Reacted on this zone. Give immediate reaction after the tap, after the mitigation. Right now, we will have a flip scenario because as you can see, price flipped this demand zone. Price broke through this demand zone, and this was a valuable demand zone, valuable 1 minute demand zone, because as I said, it created inefficient push breakout structure and swept liquidity and tapped us into a higher time frame zone. So basically it has 4 criteria. So this is a really valuable zone. Okay, as you can see, we have an extreme zone up here, extreme supply zone, but this extreme supply zone did literally nothing. It didn't change character, it didn't flip anything, so this is nothing. The right supply zone in this case will be this one, as you can see, because price created inefficient push from this candle, from this supply zone, and this candle was the one that caused the break of this demand zone and the flip. So this will be a 1 minute flip zone. We are aiming for this one. We are setting an order limit, a sell limit on this block. And as you can see, because this is a equilibrium entry point, because the wick is bigger than the whole body, than the 50% of the whole body, then we will use an equilibrium entry. I'm just setting a gap box up here, placing a sell limit on the 50% of this block. Sorry, the recording stopped again. I just realized that I just filmed the whole video and the end was missing. So let's just continue. Okay. So here's the last supply zone that created inefficient push to the downside. I broke through this demand zone, and I just did set an order limit on the 50% of this candle. So this is an equilibrium entry, right? Okay, I will use a 2 pip stop loss because, as I said, I normally use 1.5 or 2 pip stop loss, but 90% of the time I will use a 2 pip stop loss. So let's just keep it that way. I will aim for the next unmitigated 15-minute demand zone, which is this one down here. This is our last unmitigated 5-minute refined from the 15-minute demand zone. So this will be our target point. Okay, as you can see, the risk-reward ratio is almost 1:9. So this is a really, really good trade. As I said, we are trading for money. We are trading for percentage, and we are not trading for our ego, right? So 1:10, 1:9 is a really, really good and huge risk-reward ratio. We will gain almost 10% profit. Just imagine 10% profit in minutes. That's a really, really good risk-reward ratio. Okay, so let's just play price forward. As you can see, more inefficient push came into the market. A pullback started. Price created liquidity just for this zone and almost broke structure, but it didn't broke structure because this is just a weak break, not a body break. So as you can see, we have a liquidity here, a really, really good liquidity line just for this zone, right? So this is one more confirmation that this zone will be the right zone and not the extreme one, because this zone has liquidity just below it. This zone has no liquidity, or maybe we can call this a liquidity, but as I said, this zone did literally nothing. It didn't change character, it didn't break supply, it didn't break demand, sorry, and didn't flip anything. This is the flip zone, and this zone now has liquidity just below it. So this is a one more confirmation. It has all the 3 criteria again. It changed character, flipped the zone, created inefficiency, created liquidity, swept liquidity. So this is a really valuable, huge opportunity zone. We are still keeping the order limit. Let's play price forward. As you can see, price swept the liquidity and tagged us into the trade. Right now we are in the trade, as you can see, and play price forward. After the mitigation of this zone, price immediately turned down, created a reversal, as you can see, and our trade is running in profit right now. Really, really good profit. And this low has been broken. This is a weak low because it couldn't create a new high. So it couldn't break above this last high point. So this means this is a weak low. And if price breaks through a weak low, we will set our stop loss to break even, as I said. So our stop loss is right now in break even. I will just mark it with a red line. Let me just change the color, please. Okay, so our stop loss is in break even. Right now, we have no risk on this trade. If it hits our break even point, there will be no profit and no loss. This is a really, really good trade. Okay, let's see what happens next. As you can see, price broke structure to the downside, but I won't set my stop loss here because this is a liquidity line. I will just keep my stop loss in break even. Let's see what happens next. As you can see, price is building up more liquidity here. So I will just keep my stop loss in break even 2. Price broke structure to the downside here. As you can see, here's a break of structure to the downside. Break BOS short, play price forward. I will still keep my stop loss in break even because of this liquidity. Price broke structure to the downside and broke the last week low, but it has liquidity and I don't want to become liquidity. I will just keep my stop loss in break even. That's the most safest way in this scenario. Okay, play price forward. As you can see, huge break of structure came into the market again. And price coming up to pick up all of this liquidity. As you can see, I will just keep my stop loss in break even again. Price is coming up to pick up the liquidity. It didn't pick up the liquidity. Let's see what happens next. Creating more liquidity. It didn't pick up yet. It broke structure, almost broke structure between innovation push. As you can see, this is not a break of structure because this was just a weak break. So weak breaks aren't break of structures. So I will just keep my stop loss in break even. Still, let's see what happens next. So break of structure happened now. I will just move my stop loss to this point, maybe just above the liquidity. So I will just lock in maybe 1.5% or 1%. So I will just keep my stop loss just above the liquidity. In case the liquidity sweep happens, the stop loss will keep me in. But this huge innovation push here and here is just an extra confirmation that market won't come back up to pick up the liquidity, and it's just heading down to our target point. So yeah, the first scenario, you can use your stop loss just the way I use, above the liquidity. The second one is just used above this last high point that created a break of structure to the downside with this movement, with this inefficient movement. So both are good because this has a higher chance to keep you in a trade. This will lock you more profit in case the liquidity sweep or the reversal happens. So let's see what happens next. And our TP did hit. So as you can see, we just booked almost 10% in maybe 15 or 20 minutes. So this was just a 20-minute trade. Actually, from 33. Okay, not a 20-minute trade, 40-minute trade. But in 40 minutes, we booked 10%, almost 10%. This is huge. In 40 minutes, you completed a whole FTMO or My Forex Win challenge, right? This is a huge trade. So yeah, okay. This was the second scenario. This was the second example. Let's see another one. See you in the next one, guys. So hello, welcome to the next example. As you can see, I kept all the drawings from the previous example. So the structure is the same. The zones are the same. The supply demand zones are the same. So everything is the same. So the 4-hour structure is still extremely bearish. So every downside movement is a main trend movement. Every upside movement is a counter trend movement. Okay, as you can see, this was the last example. This was the last trade from the previous example. We just hopped out of a trade here in 10% profit. We are happy. We are looking for the next opportunity. We have to adapt. As you can see, price broke through this demand zone. This demand zone couldn't hold the price. So the short, the main trend intentions are still stronger than the long intentions. So as you can see, this demand couldn't hold the price. And instead of holding the price, price just broke through this demand zone. Sorry. If a zone breaks, an opposite side zone will be formed, as you may know, and we will have to find the zone that caused the break of this zone. As you can see, this was the supply zone that caused the inefficient push to the downside, swept liquidity from this region, and actually price reacted on this supply zone, mitigated this supply zone already, reacted on it, and reversed the price to the downside again. So the zone that has been created, the last demand zone break, has been already mitigated. So we will have to find another zone. Maybe price will reverse from this point. Price is a great chance to reverse from this point to collect all of this liquidity, because as you can see, we have a huge liquidity trend line here. Here comes the liquidity trend line. Price just built up huge liquidity trend line in this region. As you can see, perfect liquidity trend line taps. First tap, second tap, third, fourth. So just imagine how many orders are resting just above this line. Loads of trillions and trillions of dollars are resting from above this line. So price has a really great chance to tap into some sort of demand here. Maybe this demand will hold the price. And after a demand tap, it can reverse to the upside, change character, and collect all of this liquidity from above this line and mitigate the full zone, mitigate the full percentage of this zone. Because as you can see, this was the first step. Price tapped this zone, and this was our trade idea actually. But this step didn't mitigate the full zone. As you can see, it was just a 1% mitigation. So just imagine how many orders are still resting on this zone. So those orders have to be picked up, right? So we have double confirmation, liquidity line, liquidity trend line, and the full body mitigation. So if price reverses from this area, we can hop in a long trade, and that will be a counter trend trade, as you may know, because every long trade is a counter trend trade. But we can actually do it because price has a really, really high chance to change character here, react on demand zone, and mitigate this supply zone. So, okay, let's see what happens. We have still the same zones. Everything is the same. Let's see what happens on a 1 minute time frame. So as you can see right now, we are on the 1 minute time frame, and we are waiting for this liquidity trend line to be swept. We are waiting for this full zone mitigation. So let's just play a price forward. As you can see, it mitigated down the areas. Let's switch back to the 5 minute chart, and let's see what has been mitigated. Actually, we have this demand zone right here, and the part of the wick has been left unmitigated, but this isn't a really valuable demand zone, but it could reverse the price. Let's see what happens. Actually, as you can see, price reversed on that zone. Let's see what happens next. Price built up more liquidity, as you can see. So here's the, I don't know which tap was this, maybe the 5th tap. So price tapped the trend line for the 5th time. More sellers entered here. More orders have been opened here. So price has to collect all of this liquidity from above this line. Just look at this. How many touches, how many orders are sitting just above this line? And how many orders are sitting still on this block? Okay, let's see what happens next. As you can see, price started to change character, started to collect liquidity. Okay, huge pushes to the upside. As you can see, price did a really, really good flip here. Or maybe on this week, this demand zone flipped the whole structure from bearish to bullish. As you can see, it created change of characters on several places. So loads of change of characters here. And loads of orders has been already collected. Okay, we can mark this zone out. Actually, we have this clear demand zone because it changed character on several places, collected liquidity, changed character, flipped the supply zone. So yeah, actually, this is a really, really valuable demand zone. We can set an order limit on this one, and we can use the 50% of the zone because this will be another equilibrium entry, as you can see, because the wicks are bigger than the 50% of the whole body. So I will just use the equilibrium entry again. 50% entry set, 2 pip stop loss again, because we always use, not always, but 90% of the time I use 2 pip stop loss. So it has been just set. I will just aim this zone because, as I said, there are still loads of orders sitting on this zone, and the liquidity trend line is just above this zone. So price has a really great chance to tap this zone. Okay, so our order limit has been set. Let's wait for price to tap this zone. As you can see, it's creating new highs, created another liquidity line here, as you can see. So more sellers entered the market here. And as you can see, actually, we have double taps right here. So more liquidity needs to be collected. So this is one more confirmation for the longs. But just a reminder, long trades in this scenario are still counter trend trades. You have to know that you're trading a counter trend trade or a pro trend trade. This will be a counter trend trade. It has lower possibility to go in your favor, but it still can be good. Counter trend trades are still good. You just have to know the higher time frame intentions, and you will have to know that where can price react and set realistic targets for your counter trend trades. Okay, so as you can see, reversal has started. Price building up more liquidity, as you can see, built up liquidity on this line, and it's on the way down to sweep that liquidity, and all of this liquidity has been built up for this demand zone. Okay, so let's see what happens next. Let's just play price forward. Built up more liquidity here, as you can see. So loads of orders has been opened on this touch too, because this was a supply zone, or this was a double tap. I don't know how you call it. Just loads of orders has been placed on this touch also. So just imagine how many orders are still sitting here, how many orders are sitting still here. So yeah, I just play price forward. We are waiting for this demand to be tapped, and we have an order limit on that demand zone. Look at the slow movements. So these are slow movements. Let's play price forward, extend our zone. Okay. Play price forward. As you can see, more liquidity has been built up just for this zone. As you can see, here's loads of liquidity again. Play price forward again. Liquidity has been swept. Zone almost tapped, as you can see. Let's see what happens. Okay, and actually we are tagged into the trade right now. As you can see, it mitigated the 50% of this demand zone, and we are tagged into the trade. So price collected all of the liquidity from this region. So as you can see, this region between the demand zone and between this high was just a liquidity built up just for the demand zone. So all of these bottoms, all of these trend lines, all of everything in this area was a liquidity for this demand zone. As you can see, price swept all of the liquidity, and after the demand tap, it reversed immediately. Had a huge recovery, had a huge rejection, as you can see. But price has still got a liquidity trend line in this region, liquidity trend line in this region, double taps here, double taps here, more taps here, more taps here. So all of this region is just a liquidity again. This is just a liquidity, this is just a liquidity, this is liquidity built up for this supply zone. And we can expect the tap of this supply zone. And after the tap of this supply zone, we can expect a reaction on this zone and a change of character. And after a change of character, we can hop in a short trade and continue the main trend movement, because price needs to collect more orders from this region, mitigate the full zone, the full supply zone, and after it can continue the whole bearish movement. Okay. So as you can see right now, we are tagged into the trade. We have to manage our trade. The last high point here has been broken. As you can see, this was the last supply zone, last high point that tapped us into the trade, and this high has been broken. So we can set our stop loss into break even. So our stop loss is in break even right now, and we just mark it with a red line again. So let's play price forward. Actually, price built up liquidity here, as you can see. So I will just keep my stop loss in break even, because this is a liquidity and I don't want to become part of the liquidity. So let's just play price forward. As you can see, it's building up liquidity trend line actually, because here's liquidity trend line. As you can see, here's double bottoms or triple bottoms. So this is just a liquidity. We can expect a sweep of this liquidity and maybe reversal on this demand zone that created this push to the upside. So actually we can hop in a continuation trade here if you'd like to. So I can just mark out this demand zone. This is a really huge zone, but we can hop in a trade on the 50% of this zone. I will just use my gam box here. So here's the gam box. I will just place my position on the 50% of this zone, and maybe the 2 pip stop loss will cover. It will almost cover the zone. It barely covers it. So I will just keep it that way. So if you'd like to skip on this trade, you can actually do that because you are already in a trade from this point, from this demand zone. This is just a continuation trade. This is a scalping trade. I'm just showing you that you can scalp in a trade right here because it's actually perfect. Price created an option, move to the upside, huge recovery after the demand tap, built up liquidity here, built up liquidity here, continuously breaking structure to the upside with innovation pushes. So price has a great chance to sweep this liquidity trend line, sweep these double bottoms, triple bottoms, sweep this line. And actually the start of the whole order flow was this demand zone right here. So if you'd like to, you can enter in a long trade here, a scaling trade, a continuation trade, because as you can see, price actually broke this high too. This was a really valuable supply zone here because it created innovation push to the downside, swept this liquidity, broke structure to the downside, and price actually broke through this high point and swept liquidity from here. So yeah, it was a great chance to sweep this liquidity and sweep this liquidity also and tap into this zone. So if you'd like to, you can enter in a trade right here and you can target the same zone just on the first trade. And this zone will be 1 to 13. This is 1 to 14. So it's 2 to 27 risk reward ratio if it tags us in. But it can also sweep you out of this trade and you can become part of the liquidity. So you have to risk it. You have to decide if you want to risk it or you have to decide if you don't want to risk it. It depends on you. This is a nice trade because it has liquidity, and as I said, broke through the supply zone, swept liquidity, inefficiency, everything. So let's see how it goes. Actually, price swept the liquidity, as you can see. Created more liquidity here. Created the third bottom. Let's play price forward, reacting on the supply zone. Okay, almost tagged us in. And right now we are tagged into the trade, as you can see. So, and did a huge recovery, huge rejection, as you can see. So right now we are in the trade. Let's see how it goes. It's creating breakout structures to the upside, as you can see, huge breakout structures to the upside with inefficient movements. So after this high breaks, I will set my stop loss into break even because this was the last high that pushed us, tagged us into the trade. And price broke through this last high point, so I will set my stop loss into break even. So the first stop loss in break even, the second stop loss in break even. So both of our trades are running without a risk. So if it hits break even, we will take no loss, we will take no win. So no profit, no loss on this trade also, no profit, no loss. So we have two break even trades running. Let's see what happens next. Actually, I can play price forward. Okay, so let's just play price forward. As you can see, it's breaking structure to the upside. I will keep my stop loss in break even because this could be liquidity for this zone. So I'm keeping my stop loss into break even. If this high breaks, I will move my stop loss. Let's see what happens. Price is creating more upside movement, more breakout structures. And as you can see, price broke structure to the upside. And this broke structure to the upside happened from this candle, as you can see. This was a weak high because it couldn't break below this strong low. This was a strong low point because it changed character here, here, here. So this is a strong low point on the 1 minute structure. And this is a weak high point because it couldn't break below this strong low. And this weak high has been broken and the break has been happened from this candle. So I will set my stop losses just under this low. Okay, so both of our stop losses have been placed here. Maybe it's locked in 10% profit. Let's see what happens next. Price creates more breakout structures to the upside, as you can see, building up liquidity actually. As you can see, this is liquidity. This could be liquidity for this zone. So I'm keeping my stop loss just below this low point. Let's see what happens next. Price is building up more liquidity, as you can see. So here's liquidity on the upside, here's liquidity on the downside. Double taps on the upside, liquidity trend line on the downside. I still keep my stop loss. Let's see what happens next. More liquidity, and TP hit. Okay, so that's all. Both of our trades, both of our positions did hit TP. So the first one was 1 to 14, yes. The second is 1 to 13. So overall, we booked 2 to 27 risk reward ratio in just an hour. So we booked 27% in just an hour. This is the power of the scalings. That's actually, if you didn't want to enter on the second trade, you just booked 1 to 14 risk reward ratio and 14%, which is still perfectly fine. 14% in just an hour is incredible, right? We can all agree on this one. So, okay, this was the third example. Thank you for watching.
So welcome everyone.
in this recording session. We will test the yesterday's price action firstly on the 15-minute. So as you can see, I just replay the price 30 minutes or 15 minutes before the session starts. And let's begin. So actually, as you can see on the 15-minute price change character with this huge inefficient movement to the downside, and this was after the 4-hour supply tap and liquidity sweep. So after the liquidity has been swept, price just changed character and created inefficient movement and tapped into a 15-minute demand zone. After this, price slowly levitated back up to the supply zone and barely tapped this zone, but actually didn't tap the zone, but changed character to the downside with inefficient move again. As you can see, here was the change of character. And after this, price was slowly levitating back to a fresh and new created supply zone, this one. And after the reaction on this supply zone, price changed character again on the downside, as you can see here. So this means we have a new supply zone. Let's just find that supply zone and mark it. So this could be our right supply zone. And actually, if you take a closer look, this is a flip zone also. So as you can see, we had this 15-minute demand zone right here. And this supply zone flipped that demand zone and changed character to the downside. And price, after the flip and change of character, started to levitate back up to this supply zone. And currently, price is in that supply zone. So yeah, that's for the 15-minute. Actually, we can mark this extreme demand zone down here if we want to. Okay, so let's switch to the 5-minute. So on the 5-minute, I will mark the zones again, or I can just refine the zones if I want to. As you can see, I can refine this 15-minute zone, not much, but it's a refinement. And I can refine this zone also for this doji candle. And yeah, basically that's all. So on the 5-minute, I will mark out the demand zones. As you can see, let's start from the bottom. This was the extreme demand zone that broke structure to the upside here, swept liquidity here, and created inefficiency on the 1-minute. And this zone has liquidity just above. Okay, let's mark out the next zone. As you can see, the next zone will be this one because it broke structure again to the upside. It has liquidity again, and it's swept liquidity and has inefficiency on the 5-minute also. So this will be our next zone. So we have two possible targets or two possible turning points for longs or two possible targets for shorts. We'll see what will happen. And actually, we have this zone right here, but I believe this zone will be inducement for this zone because as you can see, here's double bottoms and liquidity. So it's more likely to price sweep this zone than reverse on it. So I will just keep that way. Okay, and let's switch to the 1-minute, right? So what can we see here? Actually, this movement happened in lunchtime, yesterday in lunchtime. So we had the first step of the 15-minute supply zone. And after the tap of this supply zone, lunchtime changed character here, swept that liquidity trend line from here, and created fake order blocks, fake supply zones here and here, as you can see. But as you may know, we have a lunchtime rule, and lunchtime will sweep all of the order blocks, and it's exactly what happened, as you can see. After price created equal tops in this line, and lunchtime actually swept that liquidity and created a new high here. So let's just play price forward and see what happens. So we are currently in the 1-minute, as you can see, and let's just play price. Okay, price change character on the 1-minute, as you can see, and New York will be open in 10 minutes. So can you guys please mute your microphone? Thank you. So as you can see, we have a change of character down here. Let's just play price more. Okay, it closed below. We have this supply zone here that changed character,
on the 1 minute. But I would actually wait for this zone to be broken. So let's just play price. Maybe we'll tap into this zone. Reverse. And the price actually broke that zone and created equal tops right here, just below the supply zone. So I would set my order on the 50% of this zone. So let's just use the gun box and put my limit on the 50% of this zone. And I will set 2-point stop loss. And our first target could be the first 5-minute demand zone I just marked. So this trade will be 1 to 9, barely. So let's play price forward. Let's see what happens. Okay. Price just keep going down. Reverses, created liquidity for this zone here. I will keep my limit here because actually this supply zone changed character first, and this supply zone just broke structure to the downside. It's a decisional one, and this supply zone had liquidity above. So let's just play price. Let's see what happens. Okay, price created liquidity on the downside, so it's one more confirmation for the shorts. Maybe it won't come back. Okay, just that happened. So currently we are in the position. Let's see what happens. Price keeps respecting the supply zone. Actually price created equal tops right here. I will set my stop loss after these lows are broken. So right now the stop loss remains the same. Okay. Okay, and now I will set my stop loss to break even because these lows are broken. Let's see what happens next. Actually, I can look for scaling trades if I want to, because we have this supply zone right here that broke structure to the downside and created an efficient move. So I could set another limit. Sorry, just removing this. So I could set another limit here on the 50% of this candle. Not a long limit, sorry, short limit. With 2-point stop loss again and targeting the same zone. Okay, let's play price forward. Pullback happening. Okay, price swept the equal tops here with this movement. So all the liquidity have been taken out. Maybe we'll tap into this zone. Let's see. No, actually price broke structure to the downside, so I will remove this order. Okay, let's see what happens. Actually, I couldn't set an order on this zone because, as you can see, this is already mitigated by the candles of the following candles. I mean the wicks of the following candles. So yeah, but we have a clear zone here that created an efficient move again. Okay, that's actually broken. So this is irrelevant. Okay, now we have two zones again, the upper decisional, the upper extreme one and the downer decisional one right here. I could set an order on this block because I believe it will be 1 to 5 risk reward with 1-2 pip stop loss. Let's see. It will be 1 to 4 with 1 to 5. Yeah, my first criteria to entry is that the trade must have 1 to 5 risk reward. And I believe if I would set the order on the downer decisional one, it wouldn't be enough. So yeah, as you can see, it isn't 1 to 5 risk reward. So I wouldn't set an order on this block. So I will just set on the extreme one. Let's see what happens. Play price. Okay, price reacting on the decisional one. Reaction. Okay, and now we are tagged into the trade. Again, sorry. So the way like this, and I will just extend this zone also. Let's play price. Okay, and TP hit. So session has just started, and the double TP did hit. First one for 1 to 9 risk reward, second one for 1 to 5 risk reward. So overall 1 to 13, 2 to 13 risk reward booked. Okay, let's just close these zones and remove the supply zone. Actually, price stepped into this 5-minute demand zone, and the tap of the zone was caused by this supply zone. So we have this supply zone. This is our flip zone. If price breaks this zone, I will wait for the long entry. If price respects this zone and creates another break of structure and breaks this zone, I will wait for a continuation entry. So we have two scenarios here. The first is to break this zone and look for a long trade. The second one is break this zone, this demand zone, and wait for a continuation short trade. Let's see what happens. Play price. Okay, a reaction on that zone. Actually, I believe price will break this zone. Strong reaction, yes. Another tap, mitigation of the almost 50%. Another reaction, price built up shitloads of liquidity on this line, as you can see. Okay, full supply mitigation. Okay, break. So actually price broke that supply zone with body closer. So we have a flip zone. We have to search for the demand that broke the structure and the supply, and this will be this dodge candle right here. This gives the reaction, and it created inefficiency, as you can see, and it changed character and swapped the liquidity from above. So we have over 3 criteria. So I will set my order on the 50% of this candle right here with 1.5 pips stop loss, and actually I would search for a higher time frame target. So on the 5-minute, this supply zone created the break of structure and the change of character on the downside. So this will be our target. As you can see, here came the impulse movement to the downside market and pushed the price to the downside and change character here and here. So this will be our overall target. Let's switch back to the 1-minute. So yeah, just target this zone. Let's see what happens next. Okay, price tagged in and actually broke this zone a little bit. It could be a liquidity collect, but let's see if it keeps us in. Yeah, it might be okay. Strong reaction, and I wouldn't set my stop loss to break even until this high breaks. So as soon as this high breaks, I will set my stop loss to break even. Okay, let's see what happens. Okay, price might broke this zone. I don't know. Let's see. It's actually fine if it's a loss because we booked 13 risk reward so far in this session, so we can take 1 loss. Okay, so price created triple tops here and swapped those triple tops, and this after the highs has been broken, I will set my stop loss to the break-even point. So our stop loss is currently in break-even. Okay, let's see what happens next. Okay, almost hit TP. Pull back, pull back, pull back. Okay, so actually the structure looks like this. So as soon as this high breaks, I will set my stop loss under these lows. But if this high breaks, it just hits TP, so it doesn't really matter. Let's see. Okay, and TP hit for 1 to 6 risk reward. So far we are up for almost 3 to 20 risk reward. So that's really good. Let's see, price just stepped into this supply zone. The overall trend is still extremely bearish, so I will look for short trades, as you can see on the 50-minute. because we had a huge change of character to the downside with this candle, and change of character again and again, and big liquidity build up on this area. So I will wait for the short opportunities. This long was a counter trend trade, but let's see what happens. Actually, we have this extreme demand zone right here that caused the top of the supply zone and broke structure to the upside and collected liquidity from the buy side here. So this will be our zone. If this zone breaks, I will wait for a short trade. Okay. So price is actually building up liquidity on both sides. As you can see, here's liquidity on the upside and here's liquidity on the downside. So it's a range. So all of the highs and lows will be swept. And as I said many times, it's basically a rule, but let's see what happens. Okay, more liquidity on the upside, more liquidity on the upside, more liquidity, and the sweep of that liquidity happened with this candle. So the demand zone remains the same because as you can see, this is just liquidity. This is a messy structure. So if this zone breaks, I will wait for a short confirmation, but I believe price will tap into this zone and sweep this liquidity on the downside. And after the tap of this zone, it might do a flip or something, or just reverse here and continue the bearish movement. But I will wait for a short trade, as I said. So liquidity is swept here. And actually, if we had a double tops here, as you can see, and price just created the third tap. So we have two scenarios here. The first one is price flips the highs with an impressive movement, and after it changes character on the downside. Or the second scenario is to tap into this zone and break this zone. If this zone breaks, I wouldn't wait for the sweep of the highs because it broke the extreme demand. So it has enough power to reverse the price to the downside, so it doesn't have to sweep the upside liquidity. But let's see, if it reacts on this demand and turns around, I will wait for the sweep of this liquidity before I enter a short trade. But if this breaks the zone, I will wait for a confirmation entry on. So let's see. Okay, price just swept the downside liquidity from this region, tapped into a demand zone, reaction on that demand zone. Okay. And price actually broke that demand zone. As you can see, it could be a liquidity sweep, but it created double bottoms again. So this liquidity is closer to price, and I believe it will go short from maybe this doji candle. It's more likely to continue the bearish movement than sweep the upside liquidity, because we created downside liquidity also, and it's closer to price. So I will just set my limit on this zone, because as you can see, this is the flip zone. This caused the tap and the break of this zone, so this is the right flip zone. Sorry, let me just finish the color. Okay, so let's just put our gam box here on the 50% because the wicks are larger than the whole body. And I will set 1.5 pip stop loss because the 2 pip stop loss wouldn't change the fact that if it's break, then price will go up for the upside liquidity. So I will keep it short because there's no more supply or liquidity needs to be taken out. So I will just keep the 1.5 stop loss, and let's see what price will do. Okay, it actually tagged us in. So we are in the trade. We have to search for a higher time frame target. And actually we have this 5-minute demand down here. And this is the only left unmitigated area, because as you can see, these wicks are all mitigated. This demand zone is mitigated by this, so this is mitigated. The only unmitigated area left is this demand zone. So this will be our target. So let's just target that demand zone. And that's 1 to 13 risk reward. Let's see what happens. Okay, price created liquidity. So here's triple bottoms. Price fed the liquidity. Okay. I will set my stop loss to break even. So stop loss is in break even because, as you can see, we have a shitty behavior and wicked behavior on these candles. So it's more safe to set stop loss to break even than let it run in with the original stop loss. Let's see what happens. Price is creating a range again, as you can see, equal tops and equal bottoms. Okay, price just barely fed that liquidity. That isn't a real sweep. Okay, more liquidity, more liquidity, more liquidity. Price fed the downside liquidity. Maybe it will come up for the upside liquidity here. Let me just mark it. Okay, it won't come back up. It just keeps breaking structure to the downside. And we are currently in the upper demand zone, as you can see. Okay, let's see what happens. Okay, price just broke that demand zone with an impulse movement. And we could actually look for a scaling trade, continuation trade on this candle. So I will just set my limit here with 2-point stop loss because we actually have this upper zone right here and the stop loss will cover it. So this will be 1 to 6. Let's see if it comes back up. No, it actually broke structure and it actually hit TP. So yeah, one more trade hit for 1 to 13 risk reward. And it's actually New York close. New York we close in 30 minutes. So we can look for long trade after this zone breaks, or we can look for a short trade after this zone breaks. There are always two scenarios. That's why I always say don't predict, just react on what market gives you. So yeah, liquidity built up again. Okay, and price actually broke that zone, but New York will close in 10 minutes. So I wouldn't look for any more opportunities. So this session has ended, and actually we collected, let me just count. We collected 9, 5, 13, almost 20. So we collected more than 30 risk worth, 30% only on this session. So yeah, that's basically the backtesting session. That's how I backtest my trades, my skip days. So yeah, let me know if you liked it. You can unmute yourself, or if it's safer, I will just stop the recording.
Hello guys, welcome to the next video. In this video, we will talk about the lunchtime rule and the lunchtime fake zones. First of all, what is a lunchtime? We have a 1 hour time window before New York opens, and we call this time window as lunchtime. It lasts for an hour from 1 p.m. to 2 p.m. Budapest time. In this 1 hour, the volume is lower, it's usually lower, and price creates fake supply and demand zones. 99% of the time, these zones will be fake in this 1 hour time window. So this is really, really important. You will have to backtest this, and you will notice that every zone, not every, but 99% of the zones will be fake in this 1 hour time window. But you can actually use these fake zones to your advantage as a liquidity. Okay, let me show you an example. As you can see, price is moving an uptrend here, reacted on a higher time frame supply zone. This was a 15-minute supply zone. We are on the 1-minute chart right now. So it reacted on a 15-minute supply zone, and the trend is bearish because it's creating series of lower lows and lower highs on the 15-minute time frame. So on the 1-minute time frame, price stepped into this supply zone and changed character with this inefficient push, as you can see. This is all normal, right? This movement didn't happen in the lunchtime. The lunchtime started from, I will just mark it with the vertical line. sorry. So yeah, lunchtime started from 1 p.m. and it lasts for, sorry, 2 p.m., which is this. So this time gap, time window is lunchtime zone. In this zone, all of these zones will be fake. So as you can see, price created this demand zone right here that changed character to the upside here, here, and created liquidity on the upside. So this could have been a really good confirmation because it created an efficient push, change of character here, and liquidity for the long runs. But as you can see, price broke to this demand zone immediately, didn't respect it, and broke below this demand zone. So this proves this demand zone was fake. This was the first demand zone that was formed in the lunchtime time window. As you can see, after price did a break of structure to the downside with this movement, created this really clear supply zone that created inefficient push, break of structure, liquidity strip from this region. So you could have opened a position on this zone, right? Price reacted on this zone, but after the reaction, it blew through this zone immediately. So this is our second phase zone. As you can see, we have this clear supply zone right here that created huge inefficient push to the downside with these three candles. As you can see, it changed character to the downside here. It also started the whole order flow that broke structure here. So this is a really valuable supply zone, but we have one problem with it. It was formed in the lunchtime time window. We can't open positions on this zone because it was formed 6 minutes before New York opens. And every zone in this 1 hour time window will be fake. Okay, so let's see what will happen. I will just play price forward. Actually, I want to mark out more zones. So as you can see, the original change of character happened from this region. So actually the first candle before the inefficient push is this one right here, because as you can see, these candles are inefficient and these are already mitigated. And the inefficiency came into the market from this candle. Also, this was a flip zone because price reacted on this demand zone right here. Small reaction, inefficiency came into the market. So this is our really valuable flip zone. Okay, I will just extend this zone and we can use this zone or even this zone as liquidity for this zone. So as I said, this zone was formed in the lunchtime, right? 6 minutes before New York opens. So we can use this zone as liquidity, and this zone will be liquidity for this supply zone that changed the original character after the higher time frame supply time. And as you can see, we also have one more confirmation. 1, 2, 3, or 4 equal taps right here. And this is liquidity for the zone 2. Okay, so let's play price forward, and you will see that every zone inside of this 1 hour time window is fake. And we just play price forward. As you can see, price breaking structure to the downside here. Came up, almost mitigated the supply zone, the fake supply zone. So this is still the fake supply zone. I will just mark it with a fake text. I will just extend this zone. And in this scenario, if you'd like to, you can use this one, this upper zone, this extreme zone as your entry point. But you can also wait for confirmation entry on this one. But we are not talking about entry points right now. We are just talking about the fake zones. Okay, let's play price forward. As you can see, price almost tapped the zone. Tap the zone. So reacting on that zone, not a tap yet. Okay, now tap the zone. We are inside of this zone. And we just blew through this zone, as you can see. So let's see what happens next. Price reacts on the upper zone, as you can see. After a reaction, it reversed immediately. This could have been a really, really good entry point, as I said, but it doesn't matter right now. We just talk about the fake zones. Okay, let's take a look one more time at this zone. So as you can see, this zone was taken out by this movement. This zone was taken out by this movement. This zone was taken out by this movement. So every zone inside of this 1 hour time window was fake. Every zone inside of this 1 hour time window was taken out, mitigated, blew through. So every single one, even this wick right here, this wick right here was fake also. It was just a liquidity for the upper, not lunchtime zone, as you can see. So I won't show you any more examples because I want you to backtest this. I want you to search for every single New York session and look at the lunchtime zone, lunchtime 1 hour time window before every New York session. And you will notice that every single lunchtime zone is fake. Okay, take care, guys. Goodbye.